Today, we're going to talk about one of the things that people are most interested in when they come to a personal finance class. There's something about just knowing that you can actually invest your money in a way that will make you money, but there's also that obvious risk associated with knowing that sometimes investments go down in value. So people are naturally very concerned about the way they invest their money. They want to make it they want to invest as conservatively as possible, but they also want to make sure that they maximize the kind of investment yields that they get. It kind of creates a confluence for people of emotions where it's very difficult to understand and to appreciate what you should actually do. I think we can show you today some things or some tools that'll make it so that you'll be far more likely to be successful if you can accept some general principles that have been well documented by all the greatest investment minds, I believe, of all time. But I'll also kind of warn you about the kinds of things that make it so that some people make gigantic mistakes. Unfortunately, when some people invest even their first dollars and they put $2,000 into the market or something, but they put it in a single company stock and it goes down, they're so concerned they just want to know, where'd my money go and how did that work? And there's good reason for that. So we want to make sure we've prepared you efficiently for it, and we have some understanding of what we'll do. With our students at BYU, we've had a little fun. We've talked about this concept of beating the street. They call it that thing, and they call it that. They use that terminology when it comes to performing better than the rest of the people are performing in the stock market. That's kind of a fascinating notion that we all have, that somehow the definition of having a good investment is making sure that our investment performs better than everybody else does. So when we say the street, we're talking about Wall Street. That's a very common thing to call it. I want you to just kind of see all those things that we've done with the students here at BYU. I think you'll have a fun time knowing that there's a lot of real scientific, really kind of empirical evidence to suggest that there are some things that you can do that are better than others. Before talking about anything like this, let me give you a couple of caveats or warnings to make sure that you understand where we're coming from. Whenever we talk about investments, we quickly start talking about what an investment can be worth in the future. It's very critical as you see any of the kind of numbers that we'll put up on the screen or any of the kind of investment approach to understand two things. Number one, a number in the future is only as good as whatever that number could be computed based upon what has taken place in the past. You've probably heard it a number of times before. Nothing about the past guarantees the future. So make sure that as you see numbers, you always have that kind of overriding awareness that indeed it's a projection, and we use projections so that we can motivate, so we can understand, and so we can appreciate what kinds of differences we can make in the future if the market continues to perform the way that it's performed in the past. And we have some certainty. We'll show you some nice consistency that has taken place over the long term. Short term, it's very erratic and irrational. But long term, it's been fairly consistent. And so that's the first warning that I'd like to give you. Is just make sure you're aware of that and appreciate the fact that they're given just for knowledge purposes. So, and then anything else that we talk about in this class, there's kind of something in the industry that they've always used to just say this. This information is meant for the general population. This is just a class where we talk about general principles, and we don't deal in a specific that would make it so that you, based on anything that you see on the information that we have here, would go out and do something because of what you've heard. Nothing that we talk about is designed to be a specific recommendation for you as an investor, only as a principle or only as some kind of a paradigm that we've used in the past to motivate and understand and appreciate just how significant investments can be. Because we talked about this, we started off with talking about beating the street. I want to show you a book I want to show you 2 or 3 or 4 books that I've always recommended to people, because often when we get to the end of this class, the students will say, could you just show us some really great places that we could go to learn that material or to expand our knowledge on it? So fortunately, the first book that I'm recommending to you is one that's written by Peter Lynch. He was a guy that was the chairman of Fidelity Magellan, one of the most successful mutual funds of all time. Once he finished managing Fidelity Magellan, as he quit, the first book that he wrote was called Beating the Street. And it was just an opportunity for people to recognize or see from a very successful mind what he'd used, the tools that he'd used to perform so well. I like the book. I think it was well written. I think that Peter Lynch was a brilliant man, and I would highly recommend it to anybody. Peter Lynch actually, before he wrote that book, he wrote the one that was called One Up on Wall Street, which is still some of the same kind of flavor. It's still, how can we somehow be just a little bit better than someone else? It's fascinating how we all determine or calculate value based upon how well we've done compared with others that are investing their money at the same time. But that's okay. Still, great book. Both of them, I think, are highly recommended. Either one of them, I think you could learn some very significant things about how the market works today. The next is one that's kind of been out there for some time. This is really, most people in this industry would call this the investment Bible. This was written by Benjamin Graham clear back in the 1950s, and it's just stood the test of times. It's been out there forever. It's a classic bestseller. It's the one, here's Warren Buffett even recommending it and talking about how he actually uses the same principles that Benjamin Graham talked about in The Intelligent Investor. Highly recommended. It's a great book. Another one that I think that you'll appreciate, whenever I talk about Warren Buffett, it's nice to find that he also wrote this thing that's called The Essays of Warren Buffett, Lessons for a Corporate America. Once again, he's actually putting in print some of the things that he's used to be as successful as he has. Certainly in our day today, whenever anyone mentions anything about Warren Buffett, you can tell that people's ears perk up. They want to listen. They want to hear what Warren Buffett has to say. And I think these are excellent essays where he describes, indeed, the kinds of things that he's utilized himself to be as successful as he has. The last thing I'll just tell you is this: is on our website, we have actually rated different books. Now, we rate them on a 5-star, up to 5 stars, down to 1 star. You'd imagine that there's some that I would not recommend quite as highly for obvious reasons, but there are those that we've given 5 stars to. There's a lot of them. I want you to know that there's some very excellent materials out there. We're going to actually change something on our website before long. We're going to make it so we don't tell you what the ones are. I just feel like if you see, I don't know that there's many books that have been written about investing that I haven't read. And I'll just say, if you don't see it on the list, there's a very high probability that I don't recommend it very, very, very highly. And for that purpose, I just don't know that it's very beneficial to necessarily say something negative about someone else's book. I'll just say this one thing. Unfortunately, we've come to find this, that probably the books that I would recommend the least, or have what I refer to as the least helpful advice, are the ones that are the most popular. Now, you think today, in the books that are out there today by some of the authors that you've kind of heard a lot about before, or they've just kind of been on a number of radio programs or TV programs, or they've got their own radio programs or whatever. What's very common, I'll just tell you this, very common, is what they'll have is kind of a signature message. A signature message, that one that I think that I call it signature because it differs from anything that you've heard before from other people that are providing you good advice. And that signature message, unfortunately, is oftentimes highly emotionalized into what I refer to as highly irrational ways of doing things. But because they're irrational or emotional, it makes it so that a lot of people somehow feel like, well, it must be correct because it's so different than anything I've heard before. I would only caution you that just because a book is a bestseller, it does not necessarily mean in any way that it would rise to the top of any list that I would recommend for you. I would highly caution you to be very careful. Once you get outside of the kind of the signature message that these authors have, then 95% of the book is just fine. It's just kind of what you'd read any place else. I would only make sure that you stick with the minds that have obviously been very successful and can obviously provide you the kind of information that hopefully will make you a successful investor without making too many mistakes. Now, I do put up here, this is for my students really more than anything else, my students at BYU. There's been a number of programs that BYU has put out over BYU TV where we've talked about investing or debt management or budgeting or resource management or something. Those can all be found on the internet, and there are good opportunities, I believe, to understand just a little more, in a little more depth, the kind of things that we're talking about. You see the one right at the top of the screen there is investment basics, and I just think that's a nice opportunity to find things that we might not be able to talk about here today that could help you as you look to things that would help you the most. Whenever I talk about investments, I love to try to make it as simple as possible. That would be another caveat I'd like to give you today. You're not going to be a sophisticated investment advisor by the time we finish. In fact, I would like to suggest that what you'll probably be is someone who has a general knowledge of general principles of investing with enough detail to make sure that you understand the principle. So here's one detail that I hope will be helpful for you. Whenever, and I remember, I try to summarize it in a way that recognizes and acknowledges that we've got a wide base of people who would be listening to a class like this. Whenever I talk about investments, I like to divide investments into 3 different types of investments. Basically, everything falls into one of these 3 categories on some level. The first is what we refer to as equity investing. That is when I go to invest in like stock in a corporation, or when I go to invest in real estate, something like that. Equity, another word for equity, is ownership. So I go to invest, I want to make sure that I own a part of the company. When I own a part of the company, then the only thing that they're obligated to pay me is really nothing. I shouldn't have said it that way. They're really obligated to pay you nothing on it. It's only as they make a profit that they decide or they elect to pay out to you. And so, but that's part of the risk that you have in investing in equity. Fortunately, because there's an additional risk associated with investing that way, there's also an increased rate of hopeful return that you could get. And so, I might buy 30% of a corporation or something like that. Whenever I purchase something, especially in a corporation, I have a piece of ownership, then I'm going to purchase that one thing that you've all heard about before, simply called a share of stock. So the share of stock depends on how many shares are outstanding in the company. If the company has 1,000 shares of outstanding stock, and I own 100 of those shares, I actually own 10% of that corporation. So that's how they keep track who actually owns the company. The second category is what I refer to as debt. Debt's this: corporations, banks, governments, many different types of legal entities need to periodically raise money by, instead of floating stock or selling off a percentage of their corporation, they like to just issue debt. The debt is where they give you, you might give them $1,000, and once you've given them $1,000, then they give you back a bond. You'll hold in the company. The bond certificates in the market today are generally worth $1,000, and so you hand them $1,000, and they say, okay, we'll give you a bond of $1,000 that says this. We'll pay you an 8% return on your bond or something like that. So they'll pay you a fixed rate of interest over a specified period of time. And when that specified period of time has expired, they'll return all of your principal to you. This is a less risky way of investing your money generally, because it's paying an amount of interest that the corporation is obligated to pay to you. They have to pay it. Just like when you take out a mortgage on your home, you're obligated to make the payments, aren't you? And if you can't make those payments on your home, what happens? They can come take back the home. Well, the same thing is the case with bonds. They're obligated to make those payments, and if they can't make the payments that they've promised to make, then the corporation would have to go into bankruptcy because they just simply cannot make those payments. And so it's obviously simplified, but so far we've got equity, we've got ownership in the company, we've got debt. This is where you just take out, where you give them a loan and they promise to pay it back at a certain rate of interest within a certain period of time. The last category is simply what we refer to as derivatives. They're more complex, but let me just see if I can put it this way. A derivative is when I want to buy the opportunity to profit or to benefit from a transaction, but I never actually buy the asset itself. Let me give you an example. If I wanted to go out and buy some futures in pork, or in pigs, this is a classic example of the way this can work. I might say this: I'm going to make a bet. I don't like calling it the bet, but so many people do that I'll allow that to be the way we talk about it here. I'm going to bet that the value of pigs is going to go up. So see, I can right now say, the average pig, I think, takes about 6 months before you can slaughter the pig and use it for its meat or whatever. So I'm going to bet right now that by the time that pig has gotten to the 6 months out there, that the value over that period of time, the price that you have to pay for a pig is going to increase. I can buy a pork contract that simply says that if the value goes up, I will make money. But there's other people out there that will bet against that, and they'll say, we believe that the value of pigs are going to go down. So we just, in this case, we call them puts, we call them calls, we call them straddles. There's all sorts of different ways that you could actually invest in something, but without actually buying an asset. So in that case, I wanted to just emphasize, do we ever purchase the pig? We never purchased the pig. We just purchased a contract that says if the value of that pig goes up, then the value of our investment is going to go up. If it goes down, the value of the investment will go down. People really love these. They like them a lot because you can invest a small amount of money with the hope of making a lot of money, far more money, based on how much you've invested if you own one of these kinds of contracts. For your own information, almost never recommend that kind of investing. I can't really remember a time that I've ever had anyone that I've recommended or advised that they should make that kind of investment. Too risky, too much of a chance of losing too much of your money. And I guess at a time like this, it would help you to know this. I'm going to recommend for you today a way to make investments systematically over a long period of time, making sure that when the investment goes up, we hope that the value of our investment goes up. And when the investment goes down, we hope that the downside will be buffered by things that we call diversification and allocation. We'll talk all about those. The thing that gets more people sidetracked than anything else is that they feel like they're going to make a special investment that's available to no one else. They're going to pick the next Google. They're going to pick the next Microsoft, the next Facebook. They're going to make it so that suddenly they make a boatload of money on their investing while not having to, while watching everybody else make a small return on their investing, on their investment. I would hope that by the time we've had a chance to finish with this lecture, you'll have some perspective of what vision, what discipline, what patience, and what resourcefulness can provide when it comes to wise and successful investing. So let's talk about the first principle that's associated with what we just discussed, and that's how an investment is diversified. You've heard that before. Everyone's probably heard the word diversification. You need to make sure there's good diversification. In our classes, we're going to make a distinction that the industry often does not make the exact same distinction. So I'm just going to tell you how we deal with it in our class. The first is what we refer to as diversification, and diversification can be best explained or summarized by saying we're going to invest our money in more than one company. So instead of investing just in Google or just in Apple, I'm going to get some Google, some Apple, some General Electric, some Kodak, some Walmart, some Facebook. So see, I'll have a wide spectrum of investments that I make. That's how I diversify my investments. I highly recommend that you have a well-diversified portfolio. It minimizes some of the ugly risk associated with owning one company that ultimately that ends up going down in value or ends up even going bankrupt. It can make it so that suddenly you can lose way too much money. So diversification is the first thing, and we'll talk about how individuals who have won the Nobel Prize have explained why diversification is so critical to you. The second principle that I'll talk about is closely related to it, and some people in the industry actually use these two words together, but in our class I separate it by simply saying this. What I'd like to know also is that my investment is well allocated. So diversified meant that I didn't have the same company. In allocation, I want to make sure that I invest in more than one investment objective. So instead of just having nothing but stock in my portfolio, why not have some government bonds, some municipal bonds, some health sector stocks, some large cap growth? And we'll talk about what large cap means later, but just know that cap is short for capitalization, and that means they're large companies. The amount of money that people have invested in it are a very large amount of money, so we call them large cap stocks. Emerging markets, markets that are more international, and they're growing rapidly, and so we like emerging markets. And mid-cap, I just want to make sure you get the kind of concept of what it means to have more than one investment objective. Now it's not going to be Google and Apple and Microsoft as companies. It's going to be different types of investments that I make that'll make it so that, once again, I've minimized some of the risk associated with making those kinds of investments. Now, in order to do this, I think it's very helpful to see one way you can make almost all of this come to pass in the easiest possible way. We have in our industry something that's referred to as investment companies. An investment company, so instead of manufacturing and selling widgets like you've kind of heard other companies can do, what we're going to do is have a company that actually invests your money in your behalf. And so we're going to set up for you right now. So you're going to be the investor. We're going to set up a little way for you to develop an investment portfolio without having to be sophisticated and taking a lot of time to know exactly which companies to invest in. We're going to set it into something that we refer to as an index fund. So I call it Index Fund Inc. or Incorporated. This is an example of what we just talked about, an investment company. And here's what would happen. I would take my money as an investor, I'd put it into this index fund. Now, whenever you put your money into any kind of an investment company, some companies can charge commissions, some don't charge commissions. Whenever it's an investment company, the commission is called a load. So that some companies are what we refer to as commission company, so you have to pay a commission before the money goes in, and some are no load. Most all index funds are no load. And we're going to show you why that can be very important to your long-term investment performance to invest in no load if you can. So once my money gets into this fund, they're going to hand me back some shares of stock. So it's just like owning stock in a corporation, but instead now of owning Google, I'm going to own ABC Index Fund Inc. or whatever the name of my company is. They give me a share of stock back in that fund in order to represent the fact that I do own a piece of that fund. Once my money is in the company, they're going to use it for one of two different things. The first is using it for expenses. So obviously they're going to have to charge you some money to invest that money for you on an ongoing basis. And so we just call those the investment expenses. We're going to show you later on why it's so crucial to keep those investment expenses as low as you possibly can, because higher investment expenses can erode the ultimate long-term value of your investment in ways that when you see it, you'll be shocked to see just how much of a difference it can make. The other thing, of course, that we hope that they do the most with is invest it in stock. And so instead of you going out and buying Google and Apple and others, you're going to go, this company will just go out and buy a bunch of that stock. So let's just say, for instance, you put $100 into that index fund, and that $100 is now just owns a piece of all these different companies. Can you see how by just investing the $100, you're going to now own all the different companies that are owned inside of that index fund? I like for my students to say, now, how do you make money? So we call it the components of an investment return. So how do you make money on an investment once it's in there? If they've invested your money in stock, we obviously are going to pay you some dividends. Well, we hope to pay you some dividends. That's how you kind of on an ongoing basis share in the profits of the company. If you've invested the company in bonds, now we haven't put bonds on this one, but I just put it up here so that you'll see it. If you've invested the money in bonds, then we're going to pay you some interest on those bonds. Without regard to any kind of an investment, whether it's a stock or a bond or anything else, the value of those investments can increase in value or they can decrease in value. So one of the components of the return that you would expect to receive on a long-term basis is what we refer to as capital gains, of course, if the value of the investment goes up, or a capital loss if the value of the investment goes down. We further segment capital gains or losses into those that are what we refer to as realized gains or losses and unrealized gains or losses. And here's the difference. I buy some Google stock. Google stock goes from $300 a share up to $400 a share, and I sell the stock realizing a $100 gain. You see what realizing meant? A realized gain is when you actually sell the investment, thereby realizing the gain that you made on the investment. But what if you bought that same Google stock, you bought it at $200 a share, it went up to $300, but you haven't sold it yet. If you haven't sold it yet, then we refer to it as an unrealized capital gain. All right, so all of those components of the return flow back into the index fund. So no matter what they are, dividends, interest, or capital gains, all those components flow back into the index fund. Once they're back in the index fund, then you as the investor receive your share of all that money through what, once again, is called dividends. And dividends can be they can be derived from dividend income if, of course, it's stock, or capital gain income if in any of these investments, the value that goes up, you'll get the capital gain income. There's a third type that we won't talk a lot about right now. Sometimes a mutual fund like this or an index fund will actually give you a piece of your investment back. So they for whatever reason, just don't want to have as much money in the fund. So they'll just return, give you back a return on the original capital that you put into the fund. No matter what type of a dividend it is, that dividend, you can do one of two things with the dividend. The first thing you can do is request that the index fund just send it back to you as an investor, or keep it in an account that you can utilize the cash that comes from the fund. The second thing that 72% of all mutual fund and index fund investors do today is just have the money automatically reinvested right back into the portfolio. I know it's not highly complex in any way, but I hope you just kind of get this general feel of what an investment company is, and the fact that they're going to take care of all the investing for you, thereby giving you good diversification. Here's your components of return that you can expect to derive, and of course the dividends that you hope to receive based upon being in that fund. Let's just look at allocation right now from another perspective. I'd like to provide for you, or draw for you, an investment risk pyramid. Investment risk pyramid just says this: there's a ton of different ways that you can invest your money. Some are very low risk ways of investing your money. Others are high risk ways. So let's start at the bottom, and let's give you a sliding scale of investments that just say this: the most conservative way you can possibly invest your money is in what we refer to as federal treasury funds. So the United States government issues some bonds. They do it on a regular basis. I'm going to show you today that the federal government, as of today, is nearly $20 trillion in debt with all the bonds that they floated, or the money that they've loaned to people, that they've allowed others to lend to them, and now they're obligated to pay that back. Why is it's very important to understand why is a federal treasury bond so seen as so risk-free? It's ultimately for this reason. The federal government can not only tax money to pay back their debts, and they can do tariffs and all sorts of other kinds of fees, but the federal government has access to one thing that no other entity has in America today. It's called a printing press. They can literally just start up the printing press and print out whatever they need to have to pay back their debts. Now, of course, you'd say, yeah, but if they print too much money, it'll cause a lot of inflation. Could. That's a real possibility. So we don't want them to print too much. But can you see, it's very important for you to understand that any entity that can print the money that's necessary to pay off their debts, it's virtually impossible for them to ever go bankrupt in the truest sense, because they can just pull out some more paper and print up some more money. And when you loaned your money to the federal government, they promised to pay you back. They didn't promise how much that would be worth when they paid it back to you, but by promising to pay it back, they have that ultimate tool called a printing press that makes it so that they're very, very low risk. It goes up the scale. We're not going to talk a lot about them right now. Money market accounts, very, very low risk. Municipal bonds. It's important to understand a municipal government is any government in America today that is not the federal government. We talked about it in one of our other classes. So if you have the Utah State or Texas or whatever, or Utah County or Salt Lake City or Baylor, Texas, or something like that, those are municipal entities, and so they're quite risk-free also. Corporate bonds, international bonds, it just goes right up the scale. When I told you earlier that I rarely, if ever, recommend any kind of a derivative, you'll see by the time we get to the top of this, commodity funds and hedge funds can be forms of derivatives, and so they're very high risk. Now watch. Whew. See if you can catch this. Kind of get your imagination going here. If I invested my money in any one of these funds, so say I could invest in this growth and income fund right here. So I want to get some growth and I want to get some good income out of the fund. I would be well diversified when I put my money in there, because I purchased shares in an investment company. Can you see that? So I might buy, an international stock fund. So I want to make sure that I make money in international stock, and so I put my money into a fund, and they purchase 100 different. Let's say for instance they've got 100 or 200 different stock corporations in their portfolio. That means that you're well diversified by putting your money in there. But we talked about that thing that's called excellent allocation also. An allocation is taking more than one of these investment objectives and combining it together, either by just purchasing the different funds, or there actually have been some funds, super funds, that have been developed that will take three, four, or five of these different types of investment objectives, and they'll put it into one single fund. So let me give you an example of that. Let's just take those 4 funds right there. We've got an international stock fund, a mid and small cap growth fund, a large cap growth fund, and a corporate bond fund. Can you see how it's possible to take all of those different funds? Now remember, each one of them are already well diversified. Can you see how then a combination of all of those makes it so that you have a well allocated investment? We do that in these index funds through something that are referred to as preset mix index funds. We'll talk a lot more about them. I'm going to actually end up highly recommending that most all investors focus first and throughout their entire investment period, for the most part, in those preset mix index funds. So I wanted to show you one of them. See how we did it? We just took different investment objectives, we packaged those into just one fund, and we then made it so that you could take your $100, you could invest it in that preset mix index fund. Do you see that? You could invest your $100 in the preset mix index fund, and by doing that, you'd be well diversified because you'd own a little piece of each one of those, and you'd be well allocated because you'd own a company that had made it so that you could have different investment objectives in the same single fund. So now let me give you, now I run a risk by doing this. I've told my students I think it's very helpful for them to know I get right to the point, right to the heart of things when I show you how a smart investor can make really excellent money if the market continues to perform as it's performed in the history of America by utilizing these well-allocated investments. By good or excellent allocation, I want to show you what we've done down here. What we've done, we're going to show you this equity-based portfolio that's got large cap stocks, small cap stocks. So once again, we're taking 1, 2, 3, 4 different types of investments: large cap stocks, small cap stocks, developed international stocks, and emerging market stocks. So let's say that in this one, and the one that I'm going to illustrate for you, I'm going to show you how large cap stocks have performed over the last, well, since 1970, so dang near 50 years now. We're going to show you how large cap stocks have performed. We're going to put 50% of our money into a portfolio that's just dedicated to those kinds of stocks. Then we'll put 10% of our money into, whoop, that says large cap stocks too. That's supposed to say small cap stocks right there. So 10% into small cap stocks, 20% into international stocks, and emerging market stocks is going to be another 20%. So 50% large cap, 10% small cap, just kind of cross that off your page. That's supposed to say small caps, and 20% international stocks with a 20% in the emerging markets. Now watch what happens. What I'm going to do is this. I'm going to do something that we refer to as 1-year rolling returns. Every single month, I'm going to look back for 1 year. Now kind of see if you can capture this. This is one of those kind of points where it's a transformational point. If you understand what I'm talking about right now, you'll be very well placed or positioned to understand the rest of the material we'll talk about for the next few slides. All I'm going to do is every single month, I'm going to say, what did the index? I've got to describe for you a little bit what index means so that you'll know that. We have a way of telling you what basically large cap stocks have done over the last year or the last day or whatever. But we do it by, instead of adding up every single large cap stock that's out there, we might have something that's just an index, like the Dow Jones Industrial Average. The Dow Jones Industrial Average just takes 30 or 40 different stocks, and they combine them into one kind of an index, and they just say, and that's the one that we see all the time. We see the Dow Jones Industrial Average went up by 4% today, or down by 2%, or whatever it does. And so we're going to take those index performance of each of those categories, the indexes for large caps, the indexes for small caps, and for international stock, and we're just going to show you how it performs over a period of time. If we did that, and we did this 1-year rolling return like we just talked about, we're gonna take our. We're not going to worry about this for right now. I'll come back to that later on. I'll just show you this. Can you see what it looks like when we talk about the investment performance of that portfolio? Every single month, so back in December of 1970, we just went and said, what has the market done over the last year? And then we put a little check right there, and look what it did. From December of 1969 to December of 1970, it had 0% return. And then if we went to February, you'd see where the return starts to go up a little bit. But can you see how erratic, how unpredictable, how illogical and irrational the market can be. It can drive a person crazy to watch how that market that goes up and down. Look at this thing. Look back in 1974. That market dropped by nearly 40%. Can you see the 40% on your screen? 40% down. It was down by nearly 40% then. But look at here. In about December of 1982, it was up nearly 60% in just 1 year on one of those calculations that we make. So it goes up and it goes down. It's highly erratic. It's very difficult to predict or analyze. Now you can see that I have quite carefully stopped in about 2008. Why did I do that? What happened to the market between 2005 and 2008? It dropped by by the most significant amount since the stock market the crash, the depression of 1929. It just, most people listening to this are old enough to remember just how traumatic that was, to watch markets go crazy, watch companies go, massive companies go out of business overnight. It was really quite a scary time. So a lot of people got very concerned, and when the market went down by that much, they said, I can't afford to, what? Lose. They said, I can't afford to lose that kind of money, so they pulled their money out of the market. Good idea, bad idea? Watch what happened in the next year. Once again, it went up by almost 60% in the next year. Can you see what happened? So it's very difficult. There's an adage in the industry. Now take out your pen and your piece of paper, because you're going to want to take this down, take some notes. It's pretty complex. You'll see it more than once in the things we talk about. The adage is just this: buy low and sell high. Now you're going to have a lot of people come around to you and they're going to say, hey, look, I can teach you when the market's up so that you sell. So sell high. Sell high, get out right now because the market's going to go down. And they'll say, and I can tell you when the market's going to be down so that you'll know that's the very best time to buy. You're going to find that we don't promote those kind of strategies or think that there's anybody that knows anything about when the market's going to go up or down on a short-term basis. So we do not perceive that that's a wise way of making your investments long-term. So now what we want to do is this. We're just going to say that, but what was the average? It's kind of interesting. It's kind of fun. Look, there's zero right there. So there's the line that represents zero. Look at how many times that the market dropped below zero. Can you see where they dropped below zero? Kind of fascinating, isn't it? Look how many times the market was up above zero. I'm going to show you a chart later on that'll show you that basically, at least if we took it over the last 50, 60 years, the market 75% of the time is up on an annual basis, or as we do these one-year rolling returns. And about 25% of the time it's down if you gauge the market on an annual basis. We're going to show you one of the brilliant things that came from a Nobel Prize-winning economist that helped us to understand the market so much better. If we took that market over a long period of time, the average annual, the one-year rolling return was about somewhere around 11.5%, something like that. Now be very careful. That's one of those critical points where you're supposed to look at that and say, it's a number, it's a good number, it surely reflects what might have taken place in the past, but the last thing we'd ever want to do is assume that our investments are going to do that well in the future, or at least guarantee that that's what's going to happen. You have to obviously have some perspective to understand what it is. Okay, now watch. Here's the brilliance of what we found through this investor we talked about. Look right down here at the bottom. I've even put that all of this information we're getting right here comes from third parties, so it can't be guaranteed. And look, and it does not guarantee future returns. So you'll always have that little caveat on any kind of investment lecture that you see. So remember, we're talking general principles. We're talking about information that we have to rely on third parties, and talking information that surely cannot guarantee future results. Now what we're going to do is this. This represents a one-year yardstick. Now remember, I'm going to stop every month, and I'm going to say, how did the market do over the last year? And I'll put a little check on my, I'll put a little dot on my chart. And that's exactly what, and that's exactly how this graph goes. What if we lengthened our yardstick, our performance yardstick? So instead of going back 1 year each month that we do our new assessment, why don't we shift this thing into what we'll refer to as a 10-year rolling return? So now watch what we do. Let's assume that we invested your money back in December of 1970. Now, would you have liked to have been in the market during this period of time right here? That's pretty tough. So let's look at what would have happened between December of 1970 and December of 1980. So let's put a line there for December of 1980. And what we're going to do during that very tumultuous time in the market, we're just going to say, if we now stopped in December of 1980, now see if you can catch this, because this is good. If we stopped in December of 1980 and said, what is the average annual yield or investment performance on this investment over the last 10 years? Do you see what we're doing? So now instead of doing it over the last year, we're doing it over the last 10 years. And so what we'll do is we'll stop at that point in time and we'll just say this: the average annual yield over this very tumultuous time was about 11%. Pretty interesting, huh? So you kind of think, wow, that'd be terrible to be invested right here. But you have to remember what the market did during that period of time. If we took that average annual yield, it'd be about 11%. But now let's shift it. Let's make it so that you invested at the worst possible time. We're going to take you to right here. To see that? Like, what would have happened if I had invested right at that point in time in about December of it's probably about December of 1974 when that took place. Let's move our chart a little bit. Now we're going to make it so that somehow you invested right at the beginning of the worst possible time to invest your money. And you left your money in for a 10-year period of time. And we said, what would the average annual yield be? So you put your money in, and the first thing that happened, let's say you put in $10,000. The very first thing that happened is your investment portfolio dropped by 40% or lost $4,000. That's the time to panic or get real concerned about it, isn't it? So, but now we get to factor in all the other times it was up and down. What was the average annual return over that period of time? It was about 6.5%. Isn't that pretty cool? During one of the worst possible times, the worst yield we could have possibly had during that period of time was about 6.5%, at least as you look at it, if you'd have invested right at that point before the market dropped. So let's just do this. Let's change our chart. Now remember, the chart that we're looking at, this is a chart that does 1-year rolling returns. Let's change our chart so that we now do something that we refer to as 10-year rolling returns. Let's chart those two numbers that we just saw. So here's our December of 1979, about 1980 when we had that. And there's that 11%. So over the last 10 years, so if we stopped in December of 1979 and said, what's happened? What's my average annual return over the last 10 years? We'd say it's been about 11%. Then if we go out to that, let's graph that other one. The one that we just talked about that was 6.5%. And now let's do this. Let's go over that same period of time. Let's graph and show you what that chart would look like. You can see that it still looks pretty erratic, but I'm going to show you some very interesting things about it. I want you to very carefully note this. Where's zero? This is important. I mean, you don't understand this. This is really good. Watch. If we calculated our investment based upon 10-year rolling returns, did we ever lose money if we just kept our money in the market in those investments that we just talked about? You basically would have never approached zero at all. Think about that. What a brilliant notion to think that somehow, because of the way I've invested my money, I get an average yield of 6.5, an average yield of 11. I will tell you that if we took the average annual yield of our 10-year rolling returns over that period of time, it was once again about 11%. But now watch. So it's so good to see that ultimately you'd have never lost value. Now remember, there's your zero right there, and you can see that never did it even grow close to that point. But those of you who are very quick would say, but Brother Marsh, we noticed that you stopped right there in December of about 2008. Let's see what happened during that period of time. Well, excuse me, it looks like we put up that average return, and I wanted to show you where zero was during that. So there's our average. That's about that 11% that we talked about. And here's zero, so you can see that we're well within that range, which makes us comfortable as investors. But now we'll show you what took place in 2008. For the first time in the last, well, really since the Great Depression, the value of that portfolio, if you did the 10-year rolling return, that value dropped below zero. Very first time they'd ever done it. Now, a lot of you would have had the heart palpitation at that point. You'd have jumped off a bridge. You'd have shot somebody. You'd have kicked the cat. You'd have done something to demonstrate just how frustrating it is to be in the market during a period of time like that. Or you might have done something even more catastrophic. You'd have sold your investments and said, I just can't handle that kind of risk. If you'd have done that, let's just show you what you'd have missed out on. There it goes, something like we've talked about before. It climbs right back up into that territory that we talked about being a very acceptable return based upon the 10-year rolling returns that we've discussed. I want to show you someone that basically won the Nobel Prize because of his brilliance with that information right there. A guy by the name of Harry Markowitz. Harry Markowitz established something that he wrote an essay back in the 1952. It was called essay was called Portfolio Selection. And Harry Markowitz was a great economist back at the University of Chicago, and he basically started his research with this hypothesis: is there's some way? He says, I believe that there's a way you can actually invest your money so that when the market's going up, you make money, but when the market's going down, you do not make money. Whew. That sounds a little too good to be true until you see that chart that we just talked about. In fact, I'm going to go back to it because I want you to see just how important it is to see what happened during the time. Did the market ever really drop? But did you ever lose money during that period of time? You say, yeah, Brother Marsh, right there you did. But let me just point out something. This number, this point on our graph, represents what if somebody would have invested their money just exactly 10 years before that date. So if you'd have invested your money exactly 10 years before that month in 2008, then during that period of time, your average annual return would have been minus 1/2 of 1%. I think it actually got down at one point to minus 1%. I'm just going to ask you this question. If I'd have stepped up to you back in December of 1979 and said, I'm going to recommend for you an investment that over that period of time will average about 11% return. If we use our 10-year rolling returns, we're going to have an average of 11% rate of return. And the worst possible period of time during that 60-year period is for the money that you invest right before that drop right there. Every other point on our chart, you do nothing but make money. And so then I'd say, what's the worst, the downside risk? What's the worst thing that could happen to you on that investment for the money you invested during that 10-year period of time? You'd have still had 99% of your investment value. Now, most of you know somebody who's made some kind of an investment where they put their money in and lost all their money, or they put all their money in and it went down by 40% or something like that and stayed down, and then the guy went bankrupt or had some other problem or whatever, and you ended up losing a ton of money. I can say comfortably that during the period of time, during American history, there's never been a time that somebody that would put their money into a well-diversified, well-allocated, preset mix index portfolio like the one we're talking about, that would, had they left the money in so that it was well-diversified, it was well allocated, and you established this long-term investment horizon, you'd have lost money. That's a pretty cool investment. I hope you kind of see that, because almost every single other thing that we can talk about as an investment, you'd stand based on historical performance. I can show you lots of times when the people that put their money into that investment lost tons of money. And I don't know. I just have to wipe my brow and take a deep breath and pause for this moment to hope that somebody that's listening to this today will understand that there's a lot of things you can lose all your money. We're recommending to you investments through the research that's been done by these Nobel Prize winners, that if you'll allow yourself to be smart and to build wisely and over a period of time, you can actually derive, you should be able to, not based upon what we can guarantee, but certainly based on what the past has told us, you should be able to make reasonable rates of return on your money and be very successful, not losing money, but just gaining and then just putting more money in, like we've talked about in our classes called $1 Million Choices. Find ways to put more money into the investment. Let's get back to Harry Markowitz. So in his S8 portfolio selection of 1952, that's when he started his research. By 1990, he had been awarded the Nobel Prize for the information that he came up with. And here's what he fundamentally said when it comes to investment. And so he won the Nobel Prize in 1990. He said this. He said that the long-term market performance is very efficient. So do you see what he means by efficient? Long-term, although it still goes up and down a little bit, long-term, it really held its value and actually went up during that period of time. He said short-term market performance is very irrational and very inconsistent, and you should not count on short-term performance. The greatest investment minds I've ever known will say something like this. John Bogle, who started the Vanguard Mutual Funds, one of the most respected advisors out there today. He just says this. He said, my wife and I will go to dinner once a year. and we'll take with us some some of our statements where we got where we have our investments. He said we'll pull open those statements and we'll kind of look at them and go, oh, and then we'll put them away and have dinner, and that's our evening. Ultimately, he doesn't look at his investment's value every single day. Do you understand the consternation? Do you understand the emotion? Do you understand the negative depression and frustration and discouragement that's associated with looking every single day? Because every day that goes down, you get discouraged and frustrated. I'm going to teach you something that's very important about the human mind. You've heard it before. The two things that we respond the most enthusiastically to is greed and fear. Okay, do you see what I'm saying? So we love to kind of see if we can get the very best yield, but we hate to lose money. We're fearful of doing that. Can I just point something out to you? The one of those emotions that will drive you the most, that will compel you, that will force you to do something irrationally or irrational or illogical is fear. You just have to imagine what it was like back in 2008 when some major corporations were going bankrupt overnight. People were losing tons of money if they had their money invested just in that corporation. It was tough. It was very emotional. It was very discouraging for a lot of people. A lot of people had their money invested in real estate or other types of investments that it literally could have lost all of their money during that period of time. Whew. Just understand, the best investment minds there are learn to not look every day because, of course, it can absolutely drive you crazy. So just short-term performance can be very irrational and inconsistent. So the key to performance is what? To make sure that you're well diversified, which we would add to this also and well allocated, and that you have a long-term market performance vision. This is something that Harry Markowitz said in 2008, right at the bottom of that recession. So right at the bottom of that major period where it dropped so much. He said, in choosing a portfolio, investors should seek broad diversification. Further, they should understand that equities and corporate bonds also involve risk, that markets inevitably fluctuate. They inevitably fluctuate. You have to understand that. And their portfolio should be such that they are willing to ride out the bad as well as the good times. I want to share the others. This Nobel Prize is such a wonderful, just looks like a beautiful award. It's just so perfect. Let me show you some of the others that have won it. So I told you this, that in the 1990s, there was Harry Markowitz, who along with two others. So after he started his research, he picked up two other researchers with him, professors at the Stanford University, and they won the Nobel Prize back in the 1990s. Then in 2013, three other individuals won the Nobel Prize in this category or classification that we call asset valuation. Assets, so investments. Evaluate, how do we value those investments? How do we know, how to make those investments wisely? I'll tell you that every single one of these individuals, we've looked up research on each one of them, would tell you fundamentally what I'm telling you right now. Be well diversified, be well allocated, establish a long-term vision as to how your investments are managed. And I would like to just tender this possibility that you take a look at some of the brightest minds, some of the most accomplished, some of the most rewarded minds ever, and know that the things that we're telling you today fundamentally track exactly what they're suggesting. What I'm going to do, now that you kind of know, that's the icing on the cake, but there's a lot of times somebody needs a little more convincing, or maybe putting it in a way that's a little more easy to understand. So I'm going to give you about 4 different kind of perspectives about how this takes place. The first is the one that's most easy based on what we just talked about. Here's our yardstick. That's our investment yardstick, and 1 inch is going to represent 1 year. So if I just did this, I just took each year, I do my investment yield, and what I'm going to do is I'm going to take the market, now watch, between 1926 to 1999. So the S&P, that's called the Standards and Poor's, the S&P Standards and Poor's 500. They're traditionally the 5 largest companies in America. So if I just gauge the 500 largest companies in America, how did their investment performance do throughout all that period of time from 1926? So that's kind of cool. This even includes that big stock market crash in 1929. We're going to give you the entire performance. We're just going to say this. Over a 1-year period of time, if you were evaluating the value of your investment during that period of time, over a 1-year period of time, how often did it have a positive return? And there's that number I told you about 73%. 73% of the time it's up, about 27% of the time it's down. If we then lengthened out our yardstick, you see what we're doing? That's a hopefully you kind of catch that vision. If we lengthen out the yardstick, now let's take it out to 5 years. Let's just say instead of gauging every month what it's done over the last year, let's every month gauge what it's done over the last 5 years. If we took it over 5 years, so we did a 5-year rolling return, how often during that huge period of time, some 75 years, how often would the market be up and how often would it be down? If it was over a 5-year period of time, it was up 90% of the time. Now remember, the longer you're willing to kind of have the longer perspective, the longer the kind of perspective that you have about this, the better off you are when it comes to actually having positive returns on a regular basis. But now let's take it out to 10 years. There, we're going to lengthen it out now. We're going to call it 10 years. On a 10-year period of time, you're going to see how it even goes up higher. Over a 10-year period of time, the market was up 97% of the time. That's pretty cool. So that's just every single year. How often was it up and how often was it down? 97% of the time. Now, and when I say every single year, I said that wrong. Every month, if we look back over 10 years, how often would it have a positive result and how often would it have a negative result? Now let's have one more that's really fun to look at, and that's over a 20-year period of time. So if we had a 20-year rolling return, it would be up 100% of the time. There'd be no such thing during all that time. If you had a 20-year investment horizon that you could look back over 20 years and see what it's done, there's not a single period of time that it ever lost money. Let me just put it in one more. This is another visual, kind of says the same thing, but it helps you to just, I want to make sure it's very firmly ingrained on your mind why this long-term performance can be so helpful. So now let's do this. Now we're going to say, how often did it have a positive return and how often did it have a negative return? Now it's not how often did it have, but over those same periods of time, what was the highest rate of return on a 1-year basis? What was the lowest rate of return? Let's just see if you can see how it works. So here's 1 year. So if we did that over a 1-year period of time, I want to know what's the highest possible yield I could have possibly got in that investment during that period of time, and what's the lowest yield? The highest yield was 53.99%. There was 1 year that was up by 53.99%. There was 1 year that it was down by 43.34%. That's huge. That's mania. That's ugly. That's frustration. That's slit your wrist. That's jump off a bridge. That's looking at the investment on way too often a basis. So let's just lengthen it out. Let's just say 5 years. What's the highest possible yield that you could have averaged over that period of time? And the yield was 28.55%. Boy, wouldn't you love to have been in during that period of time. Up 28.55% over a 5-year period of time. What's the worst that you could have done? It was at 12.47%. So you can quickly see how those wide, ugly swings that drive you so crazy begin to be tightened significantly when you lengthen out the period of time that you're measuring the performance of your investment. If you did it over a 10-year period of time, your very best yield would have been 20.06%. Your very worst yield, now watch this, you'll see the real tightening now. The very worst you could have possibly done over a 10-year period of time is down by 0.89%. That's just miraculous until you see this. What if you did over a 20-year period of time? Over a 20-year period of time, your very best yield, I'd like to have been in the market during that 20 years. During that 20 years, you've been up 17.87%. But what's the worst possible yield that could have happened over a 20-year period of time? The worst thing that could have possibly happened was your portfolio would have up by 3.11%, 3.11%. That's what we're talking about when we say, if you kind of have that long-term performance base, then it's obviously very easy to see how it can strengthen overall your performance. I want to point out one more thing. Now, what we're going to do is take stock market mutual funds. So see, a lot of people, I can't tell you, I do this professionally too. And so I not only deal with it with my students that I have, my young students, with my older students, but clients that will come to me regularly and say, but Brother Marsh, the market's up now. Shouldn't we get out? And you say, well, if it's up, does that mean that it's up at its highest point, or could it go up even higher? You see the frustrations that you have. I want to do this. Between 1992 to 2011, so that's about a 20-year period of time, 20-year period of time, we're going to take all the stock market mutual funds that are out there today, and we're going to tell you what the average yield was in those stock market mutual funds. So the average stock fund return over that period of time was 8.2%. That was a period of time, and we're going to show you what that period was. It included a period of time where for about 10 years, the market was as flat as it could be. So so we were only up 8.2% during that period of time. But now see if you can catch this. That's the average stock fund return. So the fund itself was returning 8.2%. If we then found out what did the average investor in those stock funds get as a yield, and the average stock fund investor, and remember, this is the fund itself. Now, how about the people that are invested in that fund? What was their average return? It was only 3.5%. And whenever I show that to the students, I say, what's the difference? And they say, man, you must have had a lot of investment expenses or something like that. That's not what covers it. What covers it is the emotions that we sometimes experience when we try to beat the market. You actually, in this case, you had 134% better return if you just had that long-term performance mindset that we just talked about. This difference in the investment performance came exclusively because of emotional reactions, where when the market went down, people would get scared, they'd pull their money out, they'd say, when the market goes back up, then I'll put my money back in. Sure enough, the market just takes off and goes right back up in a hurry, and so then by the time they get their money back in, they've missed out on some of the best years. We're going to talk about that in a second too. But can you just see, this is one of my favorite charts right there, because that then talks about not just what the market's done, this talks about what investors in that exact same portfolios did. Their return was less than 1/2 of the overall return in that portfolio. They got scared. They had emotions, and so they got out when they shouldn't have gotten out. Here's one more way to look at that. I like to laugh at my students and say, we believe in big money. And so what I did was I got a picture of a $10,000 bill. You don't see any of those $10,000 bills out there anymore. They don't actually put them in circulation. They never really were in circulations. They were just used for interbank transfers. But let's assume that you invest $10,000 in the market. And what we're going to do is take a $10,000, we're going to take a 10-year period of time. So $10,000 in the S&P 500 between 1989 and 1999. Here's what your performance would have done. If you'd have left that $10,000 in the market during that 10-year period of time, your performance, fully invested for 10 years, now remember, this is in the S&P, this is the annualized return, this is going to be the value of your $10,000 investment. If I left it in fully invested, I was smart. I didn't pull it out when the market went down. I just left it in during that period of time. You'd had an 18.21% yield over that 10-year period of time. Your $10,000 would have turned into $53,278. Now, but you, like so many other investors, are subject to the emotions of the market. And so when the market goes down, what do? You get out. You just feel like you're going to wait till it's obviously going to do better, and so then you'll get back in, so you're out. What if you had your money out? Now remember how many times when we had that chart that shows what the market did, how many times did we see the big drop, and then what happened the very next year? Boy, the market just rebounded I'd love to go back to that chart and just show you how many times it did definitely go down. But boy, if you didn't, if you cut your money out of it, you got your money out of the market, you'd lose the obvious big up that was going to come right after that. What if you'd have only had your money out of the market during the 10 best days? Now remember, oftentimes the best days were the ones that followed the worst times. What if only 10 days out of that 10-year period of time you didn't have your money invested? Your performance would have turned, so you're out just the best 10 days during that period of time. Instead of an 18.21% return, your return would have been 13.84%. Instead of a $53,278 investment, you'd have $36,571. Can you see it? Can you see why that can be so devastating, to think that somehow you're going to time the market? You're going to be up when it's up and down when it's down, or whatever the wisest investors. What if you're just out the best 20 days? If you just had the best 20 days you missed out on, instead of a 13 or an 18% return, you had a 10.8% return. Instead of a $53,000 investment, you'd have $27,000. What if you're out the best 30 days? You'd have had an 8.25% return, and your investment would only be worth $22,000. Do you kind of get the vision of why it's important to not only be there, but to stay there, and to not feel like you're going to time it and you're just going to get the very right period of time? The very best thing would be to stay in for a period. Now watch, I'm going to show you a period of time that was very difficult emotionally to stay in the market for a long period, not just the short periods that we're talking about. For long periods of time, you'll see what kind of mistakes that we can make. What we're going to do is we're going to talk about this thing that there's a wonderful article that once appeared that's kind of a benchmark in our industry. So let's do this. Let's take the Standard & Poor's 500 once again. And what we'll do is we'll start that Standard & Poor's 500 in 1972. 1972, what happened? I want you to see what happened to the market during that period of time. Here we go. Do you see what happened? Look at where the market was in 1972. Look at where it was in 1982. So for that 10-year period of time, would that have been a good time to be invested in the market if you wanted to make money? For the most part, it looks like it stayed pretty flat. If you discount that big, remember that's that big 1974 we talked about right there. So there's that 1974, here's what happened. But ultimately, over that 10-year period of time, the market didn't go up very much. In fact, it was so devastating, it was so paralyzing to so many people. There was an article that appeared in the Business Week magazine that was called The Death of Equities. And there it was in 1982. It said basically, get out of equities. Equities have no more value. Anybody that would stay invested in investments in stock or in equity investments would be very unwise. The market won't handle it anymore. Get out. And if you go back and read inflation was destroying the stock market, and you go back and read that article, you can easily Google that. Just say the death of equities, and that market will pop right up. That article will pop right up for you. You'll see what I mean by it. It was very negative, and they said you should get out of that. Okay, so you got out. You did what everybody would say to you do, and you saw this period of time that was just really a kind of a devastating period where you just didn't make that much money. What happened to the value of investments after that? You quickly see that had you gotten out right when Business Week magazine suggested you should get out, you'd have missed on one of the greatest periods of stock market expansion in the history of the stock market. It was obviously a terrible time to be out of the market. I think that's so frustrating. So now, let's go, there's about 1998, 2000, 1999, something like that. Let's see what happened to the market over that period of time. Once again, for those of you who are there, and many of you that are watching this would have remembered this. This is the period of time where the market, they called it the lost 10 years. It was very common for them to call it the lost 10 years. If you'd have put your money in right there and waited until the end of that 10-year period of time, can you see how you'd have made almost no money at all? And we all were there. We all saw that. We all saw the devastating impact of that big drop that came in 2008, that another drop that came back in in the year 2001. They were really tough periods of time, and it made it so that people ultimately, quote, did not make money during that period of time. And you saw it on our chart. Boy, that thing just went down, didn't it? And you actually had a period of time there it was trading below zero of our well-diversified portfolio. So bad was that market. There were a lot of people, a lot of newsletters and magazines and others that came out and said the exact same thing they said back there in 1982 with the death of equities. Here's one by the USA Today that said, invest in stocks, forget about it. So there you are in May 8th of 2012. They're telling you stay out of the market. Why would you ever want to invest in stocks? And there were a lot. Listen, I teach investment. Since 1980 have been teaching stock, stockbrokers, registered investment advisors, other that deal in investments. I've been teaching them ever since that period of time. And I want you to know that was a devastating period. There were a lot of people that came to my classes that would just say, man, the market's done. This is just, it's not going to go anywhere. We should just kind of stay out of the market. So you, like everybody else, or not like everybody, but a lot of people just kind of followed the advice, got out of the market. What would have happened? We, since that period of time, have done very significant growth in the Standard & Poor's 500. Now, a lot of people would say, but now isn't it up? I can't tell you how many times I get that phone call during the day. But look, Brother Marsh, the market's up. We've got to get out right now. What do you think? Well, somebody could have made that same phone call right here and said the market's up. And if I'd have said, no, stay in the market, they'd have said, man, you're the dumbest guy in the world because look what that market dropped. But if you were out of the market, you'd have seen exactly what took place. It obviously could have a devastating impact on you. We would like to avoid those as much as we possibly can. So the first thing is just that very common. So we're done with that portion that just fundamentally says, stand. Now we're coming. Everybody always asks me, can you kind of give me an example of the investments that we can do this in and work this kind of, have this chance or this opportunity, potential to make those kind of returns. I'll show you exactly where you can do it in just a second. So there's why we stay in the market. Can you all see it? That's a great summary point to simply say that's why we're well diversified. That's why we're well allocated. That's why we stay in the market long term, Because ultimately, the last thing you want to do is be out during those periods of time when the market's doing so well. You should know this. I wish I could take you on a chart back to back to 1900, and you see that this is the way the market has performed in many cases. They'd have these segments of the market that for a 10-year period of time, right around a 10-year period of time, would be so flat, people would quickly start saying, the market's done, get out of the market, you're not going to do anything in the market, why not just go put it into something that'll get you 2% return or 3%, you'll never make any money, and then suddenly the market just explodes. And fortunately, now you've been through it, you've seen it just like we have since 2008. There was another one of those 10-year periods of time where people made almost no money whatsoever, but then you end up pulling out, and you can see what the difference can be, and what kind of investment returns you could lose out on by doing something like that. The next thing I want to talk about is this. That's why you stay in. Now, while you're in, there are these things that we call investment expenses. Investment expenses, like we talked about, remember we set up our index fund, we said there's two things they can do with your money. They've got to have some expenses to invest your money for you, but then you hope that they do a lot of investing. I bet you it would not surprise you to know that there's a wide swing in the kinds of expenses that you can incur inside of an investment. The one investment today that has the highest expenses, unfortunately, is inside of 401k plans, so the plans you have with your company. Now, that's not the case in all plans, and I will tell you this, with pending and with proposed regulatory action that's taken place over the last 6 or 7 years, I have to tell you this, those expenses have dropped a lot, but I'll tell you they can be very devastating. The second most expensive place long-term to have invested your money is in something that we refer to as an annuity. We'll talk a little bit more about annuities when we talk about so your money has a death wish. I'll just tell you this, annuities are issued by life insurance companies. Annuities are, like these others that we've talked about, they are investment companies. So if it's a variable annuity, it's an investment company. So the life insurance company will take your money and they will invest it in your behalf, but their expenses are very high relative to other investments. The next is mutual funds. Their average annual expense is about 1%. I'll show you these average annual expenses in just a second. The last is index funds. That's the ones that we just talked about, and that's the ones we're going to recommend for most investors as they stay in these index funds. Here's those fees. Here's the average annual expense in 401k plans is about 3.5%. In annuities, overall, in variable annuities, I should have put variable on there. In variable annuities, it's about 3%. In mutual funds, the average annual expense is about 1%. In index funds, the average annual expense is only about 0.25%. And it's even going lower. Most of the companies, it's a fierce market right now where people are competing for your business. It's very devastating. But let's look. Let's just see what would happen. What if I'd had a money? So let's assume that over a period of time, I think this was over a period, between the time, let's just say you're 20 years old and you're going to retire at age 65 or whatever. So 45-year period of time, what would have happened if I'd have had money invested in the market? For the amount that I'm talking about, I think it was $100 a month during that period of time we found out what your investment would be worth if you put it into a 10% yield investment, but each year they pulled 3.5% of that off for expenses. You'd have had $322,850 for your retirement. So maybe this is $100 a month, every single month between the age of 20 to 65, so it's a 45-year investment horizon. You'd have had $322,000 in your investment. What if, instead of having that invested in a 401k plan, you'd have had it invested in an annuity that didn't quite take as much out, then your investment would be worth $379,000 or 17.4% higher investment value because you had that lower investment expense. But now watch how these last two really take off. What if you'd have had it in a mutual fund? So 10% yield, but they only pull off 1% so that your net yield is 9%. Your investment value by the time you retire would go clear up to $740,000, literally nearly double what you'd have had if you'd have had it in an annuity. Or the investment would have been 129% higher than it would have been in a 401k. Do you see why? I just want to make sure you see very clearly why investment expenses can be so critical to your long-term investment values and performance. If you'd had it in an index fund only charging 0.25%, your total investment would be $807,000, or an investment of 150%. I know when you see 3.5% and 0.25, you think, that's That's a small number. Look what that small number did over a long period of time to the ultimate yield you'd have had on your investment. Can you quickly see why we say that it's very, very important to make sure that you have the lowest possible investment expenses, and index funds just have superior investment performance, and that's why we recommend them so highly. So, okay, here's a very specific recommendation for you. There was a man by the name of John Bogle. We just talked about him a second ago. He's the one that went to dinner with his wife and would look at his investment statement once a year and then just put them away. They just didn't analyze, but they had long-term vision. John Bogle was the one that started the Vanguard mutual funds. So I'm going to talk about Vanguard mutual funds for a minute. He was the one that really pioneered. John Bogle pioneered that concept of an index fund. Let me make sure you understand the critical difference between a mutual fund and an index fund. Let's say I've got $10,000 and I go put my $10,000 into a mutual fund. What happens is there's a large investment management team there that makes decisions about where they think the market's going to go, whether it's going to go up or whether it's going to go down. And they make your investments based upon what they project will take place in the market. Now remember, these are very sophisticated people who have long track records, who have lots of experience in the industry that say, hey, you give me your money and I can get you a better return because I can manage your investment company. We call a managed investment company a mutual fund. Okay, there's a mutual fund. An index fund works a little differently. In an index fund, they just buy a bunch of investments, but they don't manage them. They just leave them sitting there. How many of you have had a grandparent or somebody else that would purchase some, utility stocks or some other things, and then they bring home the stock certificate that they purchased and they just drop it into a file folder in their filing cabinet or in their safety deposit box, and that was their portfolio. And did they buy or sell based upon whether the market was going to go up or whether it was going to go down or anything like that? No. They had this long-term investment yield mindset that we're talking about, so they just leave them in the portfolio. An index fund is a lot like your grandpa's file folder that he just dropped those stock certificates in, but then he doesn't decide whether the market's going to go up or down. He just leaves them there. Now, you probably, and guess what? The average annual, the expense in a mutual fund was 1%, wasn't it? Remember on our last slide? It was 1%. What was the average annual expense in an index fund? 0.25, or just 1/4 of what the mutual fund expense was. You see? So one has a 1% because it's being managed. The other has 0.25% because there's no management inside of it whatsoever. You say, well, God, Brother Marsh, don't you think the one that's managed would do better? Actually, research will show that in most investment cycles, the index fund outperforms the mutual fund about 72% of the time. Or it can vary, obviously, because investment cycles can be so different. But I'll just tell you this, index funds have had a very excellent track record. Why? Because they've got a long-term vision, and they're not concerned about what's going on in the market or what's going on in the economy or anything else. They just buy the investment and let them sit there. Well, John Bogle was the one that first captured that, used his imagination to capture that very significant reality. And he set up these index funds. He pioneered index funds. And over time, if you talk to anybody in the industry, they'll kind of say that's the white elephant in the room. No one wants to talk about Vanguard's index funds. And so, but I want you to know about Vanguard index funds because I think they're very good. Now, I will tell you, I'll be very careful to tell you, Charles Schwab has their own index funds. There's hundreds of different index funds out there. So don't believe for a second that I'm trying to suggest that Vanguard always is the best or anything like that. I'm just saying they pioneered it and they've done a very excellent job and received some nice returns for the investors that chose to have their money there. So here's Vanguard. So can you see it right there? You go into your Google and just say Vanguard mutual funds or whatever, and boop, it'll pop up. There's the Vanguard funds. And when you get into the different types of research fund, the funds and stocks that you can get into, I want you to look at this, and this is called Vanguard Life Strategy Conservative Growth Fund. Vanguard Life Strategies Conservative Growth Fund. So growth meaning equity. For the most part, it'll be growth or equity. But because when we say conservative, it'll also have some bonds in the portfolio. And I'll show you in just a second how they're all evened out. But because it says this thing about this growth fund, it actually makes it so that they take 4 different investment objectives. Remember, we wanted to have we want to have not only good diversification, but great allocation. And what they do is they take 4 different allocations and they put it into the exact same portfolio. The whole thing is based upon how long will it be before you retire. So a life strategy. So in this, if it's a conservative growth, it's probably a shorter period of time, but we'll show you how that works in just a second. I want to make sure you see this. There's the average weighted expense in that portfolio since 2006. The expense is 0.26%. Remember I said that on index funds? It's about 0.25%. It's even lower than that now. They've even outperformed, than they had before. But let me just show you how it would work. Here's another one that I did. So I just showed you one. Here's another one. Here's a target retirement fund, a 2030 fund. So this is saying this: you're probably going to retire in about the year 2030. So that's kind of a short period of time. Now you're 50 years old, something like that. You're saying by about 2030, I want to be done with my work. And so there's been an adage in the industry over a long period of time. We'll talk about it later. I want to make sure that there's some alternatives to this, that you understand that. But for right now, just know that there's been this adage that said the closer you get to retirement, the less risk you need to take, and so put more of your money into bonds. And so, see, I could have a target of 2050, and if I had a target of 2050, then I'd say put more of your money into stocks. But the closer it gets, the closer it gets to where we are right now, then have a larger percentage of it invested in bonds. And I'll show you in just a second how this is allocated so that you'll see it. But once again, I wanted to show you the expense ratio is just 0.21%, so it's still well within the range that we talked about. So here's what I was talking about with the different types of years. So there's a 2050 fund that they've got, a 2045, a 2040. Each of them will, as time goes on, just put a larger portion of your allocation into bonds or more conservative investments. Let's just take one of them. Let's take the 2050 fund. I'm going to assume that everybody here is either 20 years old. Everybody listening, you're either 20 years old, or you, as we've talked about how long you're going to live, were one of those people who said, I've got at least 45 more years until I believe before I die. And if you got 45 years more before you die, then you've got a long, long time out there. Let's get you in one of these long-term investment performance, in one of these long-term portfolios, so we can maximize the potential return that you could get. Not the absolute or the guaranteed, but the potential return that you could get during that period of time. So let's just take that 2050 fund. Here's a 2050 fund. Now look, here's what I told you. They'd be invested in a number of different types of index funds. So there's your index fund. And look, in fact, I think I've circled each one of them so you'll see it. In each case, it's an index fund that your money's in. Here's a stock market index. Here's a bond market index. Here's a European stock. Here's a Pacific stock, an emerging market stock fund. And you'll see what percentage is in each of those. Because we're in a growth fund, one that's for a longer period of time. Look at it. 72% of the money would be invested in this stock market index. So those that you heard bond market and that kind of stuff, that's a very small amount of your money, but you can see how there's more than one investment objective all packaged in to just one fund that you can put your money into. I think they're just excellent. Let me just show you a couple of things I think you'll find very fascinating. Let me show you how well diversified you'd be. This is kind of fun. Have your money in 10 companies or 20 companies, something like that. If you put your money into that fund, and I want you to know, if you took $1,000 today and put it into that fund, this is how many companies that you'd own. In this stock market index fund right now, the companies that you'd be invested in is 3,381 companies. That's diversification. So what if one of those companies had a poor performance or even went bankrupt? You can see how it would not have too negative an impact on the overall value of the portfolio, and that's why diversification works so well. How about that bond market? In the bond market, you'd be invested in bonds of 4,762 companies. So between just those two portfolios right there, you'd have had your money invested in nearly 8,000 companies. Somewhere real close to 8,000 companies. In the European stock market, you'd have 478 companies. In the Pacific stock market, 493. In the emerging stock market, 831. Look at this. Your money would be invested total. You'd have 5,183 companies in their stock, and in bonds you'd have 4,762. Can you see how you'd have nearly 10,000 companies that you'd be invested in with that simple $1,000 investment that you made? I hope it's obvious. You can quickly see where you're not only well diversified, man, that's diversification extraordinaire, but you'd also be well allocated because you'd be in these different investment objectives. That's why it obviously works so well. So just, I want you to know, I just think that's an excellent place that somebody over the long term could invest their money and expect to receive a good return. Now, you might be one of those kind of people that would say, you know, Brother Marsh, I don't know that I want to just put it in one thing. I kind of want to get more involved in it. I want to see if I can pick some of those mutual funds myself. Can I make a recommendation to you? There's a company that's called the Value Line No Load Fund Advisor. Now, no load, what does a load mean? A load meant commission. So when you put your money into any of these funds, they only recommend no load funds. And I will tell you this, there has been some really neat research to show that Value Line is a great investment, has had a very successful, relative to other advisors, they've had a very successful performance. So here's a page. I just took this one page. You could probably get this out of the library. It's such a popular investment a resource. You could probably get a page like this out of a library. Here's what they do. Here's what they've done is they've gone through here and they said, if you'd like to have an aggressive portfolio and you have kind of an average length of time, maybe 20, 30 years before you need the money, here's how we'd invest your money. And look, what they've given you, they've literally given you the different names of the companies that they would invest in. In this case, your money would be invested in 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 different index funds, and they'll tell you exactly how much to invest in each one of them. They'll give you so there's your allocation. There's all your allocation right there. The different kinds of funds, the large growth, the large value, that kind of stuff. They'll tell you exactly what percentage of your portfolio to invest in that, so you can quickly see that that's kind of a good way to do it a little bit more on your own if you'd like to. Caveat, I don't think you need to. Unless you really feel confident that you want to do that, I still believe just an excellent index, preset mix index portfolio is a remarkable place to enjoy what I might commonly refer to as Nobel Prize winning investment strategies. Now, some of you are going to say, but now, Brother Marsh, I'm a student. I want to make a down payment on a house in 2 years, and I want to know what to invest in. What should I put my money into? Can you see how I can't have somebody put there, if I know for a fact you need the money in 2 years, in that illustration right there, if I know for a fact you need the money in 2 years, what would happen if you had $30,000 for a down payment on a house, you put your money in, and suddenly the market drops by 40%? Would you be a very happy investor? The answer is no. So what I'm going to do is recommend for you time investment horizons. And as you saw, now remember back in those Vanguard portfolios, they would give you those specific investment horizons, So you want your money out in 2020, you want your money out in 2030, 2040, whatever. So they'll give you all the different investment horizons so you can still invest in those companies with your money. But just know this. If you need your money, so I have some money that I'm going to use shortly, where should I put my money? It depends on the timeline. If you're going to use that money within 2 years, unfortunately, I'm going to tell you to go put it in a money market. Oh, you should see the yields on money markets right now. Money markets, I don't want to get too complex. We're not trying to make you a sophisticated investment advisor. Money markets are where large AAA rated corporations they will loan money to large AAA rated corporations on a very short-term period of time. So the fact that they're AAA rated and it's a short-term period of time makes them very risk-free, or at least relatively risk-free. And they're a great place to park money, but boy, you surely don't get a lot of money. You might get a yield of something less than 1% right now in the average money market in America. But this is the fact. When you need that money in 2 years to buy a home, you'll definitely, definitely, remember, no guarantees, but you'll probably, it's a highly likely that you'll have that $40,000 and it will not drop in value. I don't think, I can't remember a time that a money market account has ever ultimately lost value. Anybody that sponsors them knows that they've got to keep that value up. And sometimes companies will even pour money into the money market just to make for absolutely certain that no one ever loses money in a money market. So it's a very conservative place to have your money. If your timeline is 2 to 5 years, then you can do one of those conservative portfolios that we just recommended out of Vanguard. You can go put your money in one that was an investment timeline of, you get your money back in 2025, something like that, if you needed the money in just 2 to 5 years. If you got 5 to 10 years, then you can select one of those Vanguard portfolios that we just talked about and have it in a balanced portfolio, and what they'd refer to as a balanced portfolio. If you have more than 10 years, then you're definitely in a position to do one of those equity portfolios. Now remember, should anyone here write down, okay, then I better go put it in an equity portfolio and go do exactly what they said on the in our presentation today. Everything we say here is for general information. It's not as a specific recommendation to you. You should seek out your own advisor or make sure that you do it in a way that really fits your overall financial and investment perspective, not just on an isolated instance of what we might recommend in a short period of time here. Next thing I want to show you is this. It was one of the things that we put into a 401k presentation that we had once that we did for BYU that people responded so positively to, I wanted to show you. Many of you, now we haven't talked about 401ks a lot in our investment lecture today, but we obviously talked a lot about them in some of the other lectures that we've already done, especially our so more money than you'll ever need. We talked about the critical part of having that as part of your formula, your HX11. So your X, remember what it was to invest your money, at least 10% of your money into a 401k. So we talked a lot about 401ks there. 401ks have so many different advantages. One of the biggest advantages to a 401k is you had all those multipliers and matches that we talked about. So if I put my money into a company that has a 100% match, so for every dollar I put in, they'll put in $1. That's obviously, that buffers your risk a great deal. If you also invest the taxes that you save by putting it into a portfolio where you save the tax going in, that also buffers your portfolio in a significant way. Let me just show you how it works so you see visually what I just talked about. So here's a 401k. Here's I call it the 401k TKO. So the knockout. Here's the knockout punch about a 401k. Let's assume that over time you've been investing now. You've been, over a 45-year period of time or 40-year period of time or something like that. The total contributions that you put into that 401k is $500,000. That's your contribution to the 401k. Now, if you had the money, if you also calculated the tax that you saved by putting that money in there, remember our 50% tax match that we talked about is so you're, in our HX11. If I had that tax match, we talked about it also in $1 Million Choices. If I had the tax match of 50%, that would mean that on the $500,000 I've invested, I've saved taxes of $250,000. Is that my money personally? That's money that I would have sent away to the federal government or the state governments. So it's money that's just sitting in the portfolio because I was smart enough to invest all the taxes that I saved also. Then, what if I'd had my money with a company that matches every single one of my contributions, and so I had a 100% match? Look, with all the money I'd put in, $500,000, $250,000, if they matched all of that, I'd have $750,000 more in the portfolio. I'd have literally in that portfolio, I'd have a total of $1.5 million. How far, here's my question, how far would that portfolio have to drop before you would start losing your own money? So if the portfolio, you see what it is real quickly. What if the portfolio dropped by, if the market dropped by 10%, you'd have 1.3 million. You're not even close. You're not even close to what you had when you, so if it dropped by 10, 20%, there's 20%, there's 30%, there's 40%, there's 50%. Look at that. The market could drop by 50%, and you'd have still, can you see it? Still not lost that 1 penny of the amount of money that you had invested. So of your money that you're putting into it, you're still, and that includes the growth, so the money you put into the growth, but this is also including the money that you put in for taxes and the growth, whatever. So ultimately, the money that you put in and all the growth that you experienced on that investment, you still wouldn't be down to it. And you can see, I think we have to, so that's just employer matches, that kind of stuff. You have to get kind of a 70% drop in the market, which in the history of the American market, at least since 1900, has never happened. Never, if you're in a well-diversified, well-allocated portfolio, you're not going to drop by 70%. Or at least based on historical performance, you're not going to drop by 70%. You can quickly see how that surely buffers a lot of the risk that's associated with putting your money into those kinds of portfolios. And so I actually calculated it would have to drop by 66% for you to ever get to the point. And so you can imagine how far that market would have to go down for you to ever get to the point where that would be a genuine concern to you. So here's one more thing I wanted to show to you. So it's kind of similar, but it kind of takes something that we learned in a previous lecture and puts it together with something we've learned here. Can someone actually outperform the market for you? It's pretty tough. It's pretty tough. I shouldn't say pretty tough, based upon all of our research, nearly impossible. Now, let's just say, for instance, you have this profound need to really try to outperform the market. And I'm going to give you the benefit of the doubt, and I'm going to say you could outperform the market by 2% by sitting in front of your computer screen, by doing all the analysis, by taking all the time that's necessary to make the very smartest decisions on your portfolio. Let's just assume that you could make 2% better return on your money. And so all I want to show you is how much time that would take, how much risk you're taking, what the probability of your success would be. It would be very difficult to outperform by 2%, but I'm going to give you the benefit of that and say, here's what we've got. Instead of getting an 8% growth on the money that you're putting in, what I've taken the money that you're putting in on an annual basis, and I'm saying, what if instead of getting an 8% growth, you got a 10% growth, and I'm going to add up all the different yields that you could have gotten by getting that 10% growth. But then what I'm going to do is contrast that with, instead of doing a 2% extra yield, I'm going to say, what if each year you did the smart thing that we talked about in $1 Million Choices? Spend your time identifying and implementing excellent $1 million choices and then investing that difference in your portfolio. But let's not get a 2% better yield. Let's just do a 1% $1 million choice every year. You see what I'm saying? How much time do you spend chasing a 2% extra yield? And how much time do you spend actually identifying a 1% $1 million choice that we've talked about? What kind of a difference would it make? Ours just says this: if you got that, instead of an 8% yield, you end up getting a 10% yield. In that case, the value of your investment. And then we say, but what would happen if you just did a 1% $1 million choice? So there's a 1% $1 million choice with an 8% yield. Here's what your portfolio would end up with: the 10% yield without the $1 million choice. Your portfolio would end up being worth $448,000 with only an 8% yield. By putting a 1% more in each year, the value of your investment would be $626,000. You can quickly see why we say you'd only have a 40% better return by spending your time in something that you, for the most part, have nearly complete control over, instead of spending your time on something that you have almost no control over and a very low probability of success. You can quickly see why, to us, it makes so much more sense to spend your time making great choices instead of chasing yields that can obviously be very difficult to attain and create for you a lot of very significant challenge. Now, I'm going to break between this and the next thing that I want to talk about, this thing, so your money has a death wish. I just want to build you up for it, but then we'll kind of take a little break, because I'd like you to take a break. It's probably a good time to shut things down and consider what we've talked about so far. A lot of people, when we talk about what could happen, have a very difficult time understanding the significance or the potential that we're discussing. But then when we talk about what could happen if you make the wrong choices, for some reason the nature of the human mind understands negative outcomes far better than they understand positive outcomes. So what we'll do when we get back to this is do a different kind of a lecture that we're still talking about investing, but what we're going to do is just say, what are some of the craziest things you can do? What are some of the kinds of things that I would suggest, based upon all the research, based upon what has actually happened in the market, be some of the worst things you can do? And we simply call that portion of the lecture, So Your Money Has a Death Wish. A lot of times it's exciting to think of all the ways that you can make money in the investing world. I've always said this: the one thing we can't ever afford to do is lose all of our money. I can't tell you how many people have come to me and said they're suggesting an investment that they'd like to invest in, and I'll say, are you sure about that? Because I sense that it's quite a risky investment, and I'll even tell them I sense that it's quite risky, and they'll say something like, well, but I can afford to lose this money that I have, and I'm just shocked when someone says they can afford to lose that money. I think under no circumstance should we ever in ourselves imagine that we can just afford to lose the money. I was talking with an individual the other day who had, I've known him for some time, and he was telling me about this wonderful investment that he'd made, and he literally had taken his entire retirement portfolio of $600,000 and put all the money into just one company, and it was a company that we would, in our vernacular, say
was venture capital, meaning it had never made any money. It never made any profits. It was just kind of a startup company. It had an exciting kind of some exciting benchmarks to it, but it was still in the classification of venture capital. A good venture capitalist would tell you that if they invest in 10 companies, they expect 8 of those companies to not succeed. They expect 2 out of 10 companies to be successful. And so there's a 20% success rate. This individual had taken his entire $600,000 retirement portfolio and invested it in this one company. As soon as I said the words venture capital, this individual knew exactly what I was talking about. And he quickly it's almost like he shook and said, I just didn't see it that way. And I reminded him how important it is to categorize and have independent counsel, independent anything, a mentor, someone that can provide you some suggestions or advice prior to making some kind of investment like that. And right at the end of our conversation, I asked him if it was possible to take some of his money out of it. He said, I guess in the long run, we can afford to lose that money. This was a guy that was 65 years old that was telling me he could afford to lose that money, and it was their entire retirement portfolio. I just hope that when we talk about any kind of an investing strategy, we also benchmark that with some real fun, not fun, but very, very encouraging ways of saying there are some things that I would suggest truly are what I'd refer to as so your money has a death wish. These are things that I would be very cautious. Sometimes they might be fraudulent activities. They might be activities that are just highly risky. Venture capital funds or venture capital investments of any kind, before you go into that, will you recognize or understand that you have an 80% chance? And those are the individuals who professionally are out there investing money like that all the time. They have only a 20% chance of success. I would like to think that we have a vision. I hope that as we've talked about these investments, you've in your own mind said, it seems like with a relative lack of risk, relative lack of overall risk, I could actually have more money than I'll ever need by just investing my money wisely, by systematically and wisely over a period of time, structuring my investments so that they're well diversified, well allocated, and that I have this long-term investment horizon that I've talked about. I would like to think that you have this concept that says we just can't afford to lose money in any way. So let's talk about now. I want to make sure that as we go through these ideas that we're talking about now, some of them are fraudulent activities, some of them are just risky activities, some of them might not be the most highly successful activities that people have participated in the past. One of the questions that people always ask of me when I go to a workshop talking about investments, they say, Brother Marsh, what do you think about precious metals? What is a precious metal, and why are precious metals such kind of a hot button in the investment industry? I'll not get into it in much depth other than to just say or to suggest to you some of the things that I would hope give you some pause for considering something like gold as an investment. Looks good, looks very exciting. Let me give you some numbers to see how well these settle with you. Over the past 30 years, I want to show you an investment trend of gold. Here's 1984. If we start in 1984, this line right here represents gold. That's a gold investment. Over that period of time, can you see how much that investment has increased in value? There's been a negligible, almost no increase in value whatsoever. So you'd have had your money tied up for 30 years in the investment market, fundamentally done nothing. This line here represents the Dow Jones Industrial Average, which we kind of represent here. So there's your Dow Jones Industrial Average line. There's your gold line. Which of those would you have preferred to have been invested in over that period of time? So as a long-term investment solution, does that make sense? Here's what it's been over the last 5 years, though. So really not the last 5, but actually gold did have a bit of an uptick between the years 2005 and 2008. So let me show you that chart. So during that period of time, look where gold was. Gold was obviously doing very well, going up in value. There's your Dow Jones Industrial Average. During that period of time, if gold's going to do this well and the Dow Jones is going to do this well, then you'd like to be in gold, wouldn't you? But now look at the investment timeline between 2005 and 2008. What's happened to gold since 2005, 2008? This is the gold trend line, trending down. This is the Dow Jones Industrial Average, and this is just a 2015. Can you see what I'm talking about when I say, now if the Dow Jones is doing this and the gold index is doing this, and you're going to say, but Brother Marsh, it just seems like that's all over the map. How do I really know? I want to make sure you go back to that original chart, and find out how well gold's done over a long period of time. And I want to represent that in a number that I think you'll find very fascinating. If I took gold, the way that people have invested in gold over the last 100 years, so I'm going to go back clear to 1900 and find out where gold was trading at the time. Gold was trading at that point in time at $454.84 an ounce. And by the time we took our numbers here in in 2012, gold was trading for $1,085. That would mean that over that period of time, had you invested your money in gold throughout that entire period, you'd have had a return on your gold investment of about 238% over a 120-year period of time, or about 115-year period of time. What happened to the Dow Jones Industrial Average? This chart at the bottom of the screen represents the Dow Jones Industrial Average over that same period of time. Had you had your money invested in the Dow Jones during that same 100-year period of time, you'd have had a 31,792% gain in your investment. Can you see long-term wisdom? Certainly there are periods of time that maybe gold did outperform the market, but I can assure you this, they were very short-term periods of time, and ultimately the long-term investment that made the sense during that period was the Dow Jones or some type of an index like it, the 30 stocks that are contained in the Dow Jones Industrial Average. For you, I think it'd be fun to kind of see with some ecclesiastic perspective. Here was Brigham Young, who in the early days of the church said this to the members of the church. He said, "The time will come that gold will hold no comparison in value to a bushel of wheat. Gold is good for nothing, only as men value it. It is not half so good as the soil from which we raise our wheat." Why would he say gold is good for nothing? Can I just tell you this, of all the gold that exists in the world today, if you took all the gold that exists that we've ever mined and existed, what percentage of that gold is currently being used for some productive value? Actually, the number is less than 1%. 99% of all gold is just kind of in ingots or in bars being stored. And that was reflected by Warren Buffett, who said this about gold. He said, gold gets dug out of the ground in Africa or someplace, then we melt it down, dig another hole, bury it again, and pay people to stand around guarding it. It has no utility. Anyone watching from Mars would be scratching their head. Now, gold, well, there's a lot of you who have come to know gold, as other investors have, as a hedge against what? They say against inflation. Gold actually, over a long period of time, has, through research, been what I'd refer to as something that's not directly connected to a hedge against inflation. Gold, for the most part, is a hedge against fear. When people are fearful, they want to put their money into gold because it looks valuable. Just remember, the most important thing to understand, poor long-term investment performance. You'd really, truly have to have some kind of a short-term ability to gauge where gold is going to go before you'd ever think that somehow that's an investment that you'd like to make. And gold does not have any utility. It has little or no utility. It really has no value. Literally, it's just ingots or bars that somebody is holding on. I would suggest the first thing that I would recommend in this case is that precious metals are, in my view, not a great long-term investment and something that you want to actually be quite careful of. They'll ask me when I get to my workshops, they'll say, but I've had this. I had a client call me the other day and they were very excited. There was some company that had come in and said that they were going to teach people how to do what we refer to as market timing. Now, market timing is this. We have to know when to be in the market or when to be out of the market. We have to gauge. We have to watch those ups and downs from the past and feel like we have some kind of a very strong ability to gauge when the market's down so that you can buy low and when the market's up so that you can sell high. Let me just suggest to you what some very smart minds. So instead of talking a lot more about whether it's smart or not, this client that I told you called me literally had gone to a company that said for $40,000, a $40,000 course, they would teach people how to invest their money using market timing strategies that would make them fabulously wealthy. Let's see what some great minds have said about that before. The Wall Street Journal said market timing is a myth. The Investopedia, which is a great source of information about investments, says market timing fails as a moneymaker. Market Watch from the Wall Street Journal says why market timing does not work. The Motley Fool, 3 reasons why market timing does not work. Forbes magazine, the problem with market timing. And here's another one from First Trust that says timing the market doesn't work. Do you kind of get the flow? All the research that's ever been done. So when someone tells you that they're going to somehow show you how to time the market, you can make your own decision about whether to throw your money into that kind of a strategy, but I can save your $40,000 for you and I can suggest to you the wealth of information or material that's coming from every research project that's ever done where we actually audit those statements that people make about how much money you're going to make doing market timing. And I would suggest to save your money and just invest it the way that we've suggested it, with great allocation, great diversification, and a long-term horizon. Something that's kind of closely related to market timing that we've already talked about, but it's kind of fun to discuss it in greater depth. Now, others will come up to you and say, yeah, but I know how to invest in those little derivatives. Remember derivatives and what they did? It's where I'm not buying the asset itself. I'm just buying a contract that makes it so that when the market goes up or down, I can capitalize on the different individual markets that are there. Do those hedge fund strategies, or those derivatives or hedge fund strategies work? I've got some really kind of fun things to show you. When we talked about that, I'll give you kind of some other names that we can use for it: currency trading, arbitrage, futures, options, credit default swaps. I just believe it would be helpful for you to see what the Wall Street, what some others have said, what some great research have suggested about here. Here's the Harvard Business School when they talked about this concept in what they refer to as the Journal of Financial Economics. They did a massive research project into these hedge funds. Now, here's what will happen. Some people will come up to you and they'll say, listen, we've got some really, really sophisticated guys that really, really know what they're doing in hedge funds, and they're going to make you a lot of money. The sad thing is, a lot of times they charge very high investment expenses, like maybe 4% per year, plus a cut in all the profits that they make in the portfolio. And boy, they're going to give you some very, very powerful sounding names and strategies that will sound like it's going to make a lot of money. Look what the Harvard Business School found in all their research. They said what it results in, what those hedge funds result in, is higher risk, lower returns, and what hedge fund investors really earn. When they said what they really earn, they said that they earn 3% to 7% lower than buy and hold fund returns. That's the ones that we're talking about. Buy them and hold them, and don't worry about trying to time the market or get involved in hedge funds. Just do those buy and hold funds. The real alpha's an investment terminology for hedge fund investors. The real benefit that you derive from it, as reported by the Harvard Business School, was close to zero. It obviously did not provide the returns, so the return experience of a hedge fund investor is much worse than previously thought. So here's someone who takes the time, they go out, they do the research of all these hedge funds, and they come back with the results that say, wouldn't it be great just to know that you as an investor could accept or think that somehow you could kind of believe in that kind of research that's been done. You could avoid that strategy and probably avoid a lot of heartache in the investment market. Something that was very fascinating, something that happened about 8 years ago that I think you'll be very fascinated with. Warren Buffett. Now, Warren Buffett, we like Warren Buffett. Warren Buffett seems to invest his money, and he always says to invest your money the exact same way that we're talking about. Just well diversified, well allocated, hold on for a period of time. Warren Buffett made a bet. He just said this: I'll bet you $1 million. And he went out and he kind of established that bet. He said, I'll make you a bet that I can show you a fund that you can invest in that will outperform hedge funds. And so there was a group called the Protégé Partners. And let me just show you what they found. So Buffett went out, and what he did was he chose the S&P 500 fund. By S&P 500, I want to make sure everyone understands this concept of an index. Just know that the S&P 500 index takes probably about the 500 largest corporations in America, and that tracks their success. So we have a lot of funds called S&P 500 funds, where the fund managers will go out and they'll just buy the companies that are invested in, that are part of the S&P 500. And what they do is, in this case, they just buy the investments and they just let them sit there. So once again, remember what we're talking about. Buy well diversified, well allocated, and just make sure you hold on for a long period of time. These people hold on to them forever. They never try to time the market, or they never try to have these hedge fund strategies. So Warren Buffett made this $1 million bet about 8 years ago, and this Protégé Partners actually took him up on the bet. And let me just read you the results. The stock market index fund Warren Buffett picked continues to outperform hedge funds in year 8 of the 10-year bet. Now remember, it was 8 years ago that he made that bet, and it was $1 million bet with this group called Protégé Partners. And Protégé Partners took him up on the bet. Here's what happened. The low-cost Vanguard, remember we've been talking about Vanguard, so here's Warren Buffett recommending Vanguard also. The low-cost Vanguard S&P 500 Admiral Index Fund Buffett chose. That's the one he chose, and he said, just put your money into that. Don't put your money in this high-powered, the stuff that we think is high powered that has all these high investment expenses. And that index fund that Warren Buffett chose 8 years ago is up 65.7% since the bet began with Protege Partners. Protege Partners picked 5 funds that bundle hedge funds, and they are collectively up 21.9% on the average. Do you think Warren Buffett's going to win that bet? Isn't it great? I mean, isn't it fun when we can just sit together as a group like this and consider, well, when these people come and they recommend these really, really cool investment strategies, if I have wisdom, I'll actually look at the results that have happened in the past. Did Protege Partners have a very strong vested interest in making sure that they picked the right hedge funds? Obviously. And how did they do? They're up 21.9% over the last 8 years. Over the last 8 years, that Vanguard S&P 500 Admiral Index Fund is up 65.7%. It's not very flashy, is it? Hedge funds are flashy. Everybody gets excited about hedge funds. God, who doesn't want a hedge fund? Because obviously that's going to provide a lot of very fun kinds of returns for you that you would not be able to get any place else. And the reality is, if you just do what we've talked about, it might be a very wise thing. And I hope you do, because I hope that you find and you see that we don't want you losing your money. We don't want you to give $40,000 to somebody to do something that obviously substantially underperforms in most all instances. The next thing I'll talk about is this. We've had a lot of individuals who have gone out and made investments in funds that cannot be audited. So let me give you an example. Let's just say somebody comes to you tomorrow and they say, and I know some guy that's been investing his money in real estate, and he builds homes for people or whatever. He builds homes, he flips homes, he does a lot of kind of sophisticated real estate investment strategies. Over the last 10 years, he's made 16% per year. You think, wow, 16%? Crud, those money market funds now are only providing me less than 1%. Why would I ever have my money foolishly invested in the money market funds? I'll take all my money and just dump it into that real estate fund. Wouldn't that be a good idea? What's the problem with that representation that they just made to you? Has anyone actually ever audited a third-party investor, a third party actually audit the investment for those yields that they promised? That client that called me that wanted to spend $40,000 learning how to market time. That's one of the questions I asked them. I said, has anybody ever audited that representation that they're making to you? Have they showed you something where over the last 10 years, they were a company that had been out there for probably 20 years doing these seminars. And I said, could they actually show you somebody that's audited the statements that they've made to you? And obviously the answer was no. So could I just ask you this? Would you just put a little check on your forehead that says, no, just put it on your belt. You don't need to put it on your forehead. Just put a little check there that says, I think if somebody comes up to me and they start talking about some investment return that they can derive, one of the very first things I'm going to ask them is, can you show me that anyone has ever actually audited the representations that those individuals have made in your behalf? And I think you might find some very, very surprising ways to avoid putting your money into something that obviously could end up losing a substantial amount for you. Something else that's happening right now. I don't know what's caused it, but I want to protect you from it. There's a lot of individuals who kind of go around saying, hey, Social Security and the benefits that you're going to get from Social Security. There's a lot of different representations being made about it, about how things are just going to be bad. Will Social Security be there when the time comes? I'd like to answer that question for you right now so that I can go on record as providing you actually an answer that I'd like you to use, and that's this. If the United States government is still flying a flag, meaning they're still in business, there hasn't been a palace coup, there hasn't been somebody kind of take over and completely shift the government or whatever, something like that. If they're still there and they're still flying a flag, I'm going to just tell you this, you're going to get your Social Security. Why? Because, now remember, the federal government has this thing that we call a printing press. And I don't want to suggest that as believing that somehow that's ultimately the way that they'll fund those Social Security benefits. But I do want to make sure that you know that there's that worst case scenario that they can always provide. And that is, if they promised you, if they said they're going to give you that benefit, did you guys see what happened in Greece when they elected to somehow reduce? They were going to reduce by 1%, the retirement benefits that people were receiving. Man, there was rioting in the streets. There were burning of government buildings. People just don't give up those benefits very easily. And I'll just say, remember, if we're still waving a flag, you'll get that Social Security benefit. Now, you might get taxed more on it. Something else might happen to make it so that maybe the benefit that you derive will not be quite as significant as you anticipated. But I would not worry about that a great deal. Some other people say this: there are 1,500 different ways to calculate your Social Security benefit. There are a lot of ways of calculating it, but I unfortunately, the ones that are probably in there kind of chipping and making you feel insecure about it are someone that want to sell you an investment, some kind of an investment that probably will not be good for your long-term health or long-term financial health. And I just suggest this: just don't allow somehow this concept of too much. Can I just give you an answer for this one right here? I always tell people this when it comes to how much retirement income, when do you start collecting your Social Security? So this 1,500 ways to calculate your retirement income benefit, the amount that they're going to pay you. I just tell people this: I'd like you to start collecting your Social Security benefit at your full retirement age. Now, we'll talk about that more in another class. Your full retirement age is the age where you can start collecting what they refer to as your 100% benefit, and you can still work at something else and not have your benefits cut down. For most baby boomers right now, the age is about 66. After that, it kind of grows a little bit, so just check your full retirement age. Start on the day of your full retirement age or the day you retire and quit working, whichever comes first. So by age 62, you can actually start collecting your benefit. We'll talk more about it, but I always just tell people this: if you don't collect it until a period, somebody will come up to you and say, Brother Marsh, but if I wait for 4 more years, I'll get $300 more per month in a benefit. And I say, well, all right. So if you wait for 4 more years, that means that you're not going to collect the $3,000 a month that you're going to collect. $3,000 a month is $36,000 over a 4-year period of time. That turns into $154,000. That's $154,000 in benefits you don't collect, so that you can collect $300 more per month. Let me see, the numbers don't seem to add up, do they? It's obvious that somehow it's probably the best to just get started. So don't worry too much about all those different ways of calculating it. Don't let someone use that as a way to sell you some kind of an investment you probably don't need. Just stick with, when it comes to Social Security and security, I think you'll find that ultimately there's not a lot to worry about. So protect yourself with My Invest. So there's somebody that's going to, I'm going to protect you against that terrible thing with Social Security. They've got all sorts of life insurance policies and annuities and all sorts of things that you can buy to protect yourself. They will not be in your financial best interest, and I'd highly recommend you don't let Social Security and some of the problems, some of the fears that you might naturally assume when it comes to collecting your Social Security benefit, don't let those fears overwhelm you. And talk with somebody that can objectively and rationally talk about or discuss with you what the pros and cons are of different strategies that you have for protecting yourself. One of the things that also happens a lot of times in workshops, someone will come along and they'll recommend for you a kind of a fun investment, kind of a fancy investment. And you'll say, but I really don't have much money to invest. They say, that's okay. You have something that we refer to as equity in your home. And we think it'd be a really good idea. Our investment is so good. It's so wonderful. We'd like you to pull money out of your home. So for those who don't know what an equity loan is, just, so your home's gone up in value. Let's say your home's worth $400,000 and your loan now against your home's only $100,000. Well, then you have that $300,000 that you own in your home that'll allow you to use that equity as collateral for a loan. We get into a lot more later, but I'll just tell you this. President Hinckley, I loved it when he'd say this: my wise father taught me to buy a modest home. So a wise father taught him to buy a modest home and then incur a debt, because obviously most people cannot afford to pay the cash necessary to purchase a modest home today. But then he said he taught me never to take out any more debt against that house unless it was an absolute emergency. Can I tell you, not just from an ecclesiastical or an eternal standpoint, can I just tell you from a very strong financial standpoint, how many people have been burned thinking that somehow you can use the equity in your home to buy an investment, when investments can obviously be as erratic as they are and not provide the results that you'd like them to provide. It's very common today for people to do that when interest rates on home mortgages are so low. Just don't get caught in the trap of thinking that your investment is so good and it's so wonderful and it's so powerful, you're going to outperform the market in such a way that you can collect 6% interest while you're paying only 4% on your house and somehow make a lot of money from that. It's obviously not something that I think in the long term is going to provide you the kind of yields or the kind of returns you'd like to. Whenever you find somebody, without taking too much risk, a lot of times when somebody does something like that, they say, just borrow some money. Just borrow some money against your house and make those investments. A lot of times what they'd like to suggest for you is something that we refer to as a variable annuity or a life insurance investment. Now, I could spend a lot of time with this. I literally started teaching classes to life insurance agents, so they're pre-licensing classes so they get their license. And I also did continuing education classes for life insurance agents, stockbrokers, and CPAs back in 1980. That's when I started. That's how long I've been teaching these life insurance agents and others who sell or market these variable annuities and these investment life insurance policies. I think I can suggest with some enthusiasm that probably no one, there are very few people that know as much about those investments as I do. I have what's called a Chartered Life Underwriter designation, a Chartered Financial Consultant designation, a Masters of Financial Services, all that came on the heels or with the confidence of this information I knew about life insurance. Can I just tell you, almost unanimously, I tell people to avoid variable annuities and life insurance investments. These investments, it is an investment. So let's just say somebody steps up to you tomorrow and says this, I've got an investment. Now remember, let's just say this. You can borrow money at 4% on your house right now. I've got an investment that can only go up. It will only go up in value, and it will never go down. Will never go down. So every time the market goes up, we'll lock in whatever it went up to, and then we'll lock in on another one. We call them indexed annuities or these variable annuities. It will only go up. It can never go down. And the investment, and you can invest it in the most risky investments that you want to invest it in, and it will still do that. So if it's a risky investment, whenever it goes up, boy, we'll lock in that yield right then, and you'll never have to, and you never have to put it. Oh, okay, so another thing, there's no commission. You don't have to pay anything. So you invest $100,000, and you're going to have $100,000 sitting there. I will tell you this: they're one of the most highly commissioned investments. So in other words, the insurance company will still pay the agent that sells at a very large commission. And I'll just tell you, if it means anything to you at all, there's just one more thing I want to tell you, and then I want to show you a statement. And they say it's a guarantee. It's just guaranteed. I love to put the words guaranteed or quotes around that, just like I have here. Guaranteed. What does guaranteed mean? It means guaranteed as long as the life insurance company is still in business, and as long as these investments that they recommend for you don't go broke. And if they did go broke, what would the insurance company have to do? I can't wait for the day that some insurance company says, "Oops, we made a guarantee that was too high, and we can't afford to back up that guarantee." There's an agency that regulates all those that sell investments. It's called FINRA. I won't talk any more about it. And just trust me, it's the agency that regulates them. On FINRA's website, you go on it right now, and you're going to find when they talk about these equity indexed annuities, they refer to them as a very complex choice. And they make, and I haven't circled it over here, but I just have to. It's under investor alerts. That they want you to know they're very complex investments, and you really ought to have some very sophisticated advice before you go into that. And don't get that advice from the person that wants to sell you the contract and make a very large commission. They obviously can not be in your best interest. I highly recommend that as an investment, you avoid annuities and life insurance contracts and just do this as we've recommended before, as we've talked about. Just invest just buy term life insurance and invest your money in your 401k or some other kind of investment that I think is a lot better than that one. There are those who would like to suggest for you something that we refer to as high yields. High yield sounds good. So if I have a high yield investment, that's what I'd really like to have, a high yield. You can see my fireworks going off there. Boy, when I have these are spectacular investments. These are investments that will provide you, make it so that you can get rich very quick. You can see what happens, and then you beat the market, whatever. We had some individuals that came to us back in it's probably in a class. I'm just going to give you an example of one of them and how you can kind of get trapped in this logic. Whenever they say high risk or high yield, I'll guarantee you they mean high risk, and especially if they have some kind of a quoted yield or guarantee that's much higher than you could normally get in the market. So I walked into class one day, and some students started to tell me about this little investment that they'd heard about, that they wanted me to make a recommendation and tell them whether I thought it was a good idea. And so I asked them to tell me what it was all about, and they proceeded to tell me something about something called 12 Daily Pro. 12 Daily Pro said this: they promised if you put your money into their investment that they would pay you 12% per day on your money. Per day. That's not per annum. That's not annually. That's a per day on your money. And of course, I immediately, as soon as I heard it, I just knew that it was something that I had to convince the students. I had to show them that indeed this is something that they probably wanted to avoid. So here's the question I posed to them. I posed the same question to you. See what you think about it. I said, if somebody invested their money in an investment that provided them 12% per day, and they invested just $1, now think about this, $1, and it provided a 12% return per day, how much would that investment be worth by the end of 1 year? If you think about it, so I've asked this question in class. It's one of the funnest things we do. I always have people, they always guess very high amounts. Boy, well, I'll bet you it's worth $1 million. I'll bet you that $1 becomes worth $1 million. Somebody will say $50 million or something, just as a way to suggest some of the ludicrousy of thinking of something like that. So I show them this. Here's what your $1 investment would be worth by the end of the year if you received a 12% return every single day on that investment, and it compounded each day as you earned that. That's how much you'd have in your investment account by the end of the year. If you go to Google, they actually have a name for big numbers. And this represents what we call $3 quintillion. $3 quintillion. Now, see, we in the United States of America today have gotten tired talking about billions, so now we talk about trillions, and now we're starting to talk about tens of trillions, and so that seems like a lot of money. In fact, I looked it up just yesterday, and yesterday the United States federal debt, here's what the United States federal debt is. Right now, it's very close to $20 trillion. That's $20 trillion. See, or 19.95 trillion. It's almost now $20 trillion. And we found that by looking on usdebtclock.org, and that was on June 22nd. We found that information. Boy, look, so I wanted to continue to tell my students why that's such a big number. There's only one other place that I've seen a bigger number. There's one time I saw this number. There was 300 sextillion. And somebody had said there's 300 sextillion somethings. You know what it was? You may want to make a guess. It was NASA that actually estimated that there were 300 sextillion stars in the universe. I just wanted to show you a bigger number so you can see how quickly it gets out of control. But to put this in perspective for my students, I simply said this. We have something in our country called gross domestic product. We talked a little bit about it in one of our previous classes. Gross domestic product is just this. If I took all the money that anybody had all the income that people derive in the United States of America today, either selling goods or selling services, that's our gross domestic product. That's how much income that we're generating or value that we're adding to the economy every single year. Well, then if we took that exact same thing over the whole world, I will just tell you this. Here's a big number for you. The annual world gross domestic product is $45 trillion a year. So here's how I put it in perspective for my students. I said this. I said, you know what? If every single man, woman, and child on the planet today went out and worked their knuckles, worked their fingers to the knuckles, worked to the bone, to the core, whatever, and they gave you every single penny that they derived from all of the services that they rendered, how long would it take everyone in the world handing you all of their money to actually become worth $3 quintillion? And the answer is just this. It is 66,000 years they'd have to work to do that. Do you see why that number is so? It is beyond lunacy. It's beyond imagination. It's beyond anything that we can ever fathom to suggest that indeed you'd ever. So just, can you kind of see? So there my students were. They were very excited about this wonderful opportunity. And I will say this, the FBI shut down that group not long after that. But if you go on the internet today, I'll guarantee that you can find 20, 30, maybe 100 different groups that are trying to promote something similar to this, where they pay you these very high rates of return every single day. Would you please avoid that? That is, it's fraudulent, so it might be a good idea to at least know that it'd be a good idea to not put your money into something that ultimately could end up losing everything. Something that was very closely related to that Social Security that we talked about before was when people get so panicked about the IRS and they fear so much losing all their money to the IRS and the taxes. They'll make statements like, "I'd be filthy rich if it weren't for the IRS," or something like that. So somebody comes along and says, "Man, I've got here's the best investment. It gives you tax-free income, or it provides you tax credits." Or, you see, it's really easy to get people to buy investments that are because a person is fearful about taxes. So they're going to protect their investment, protect their money by putting them into these very exciting investments. I wish I could be there every single time someone recommended for you that kind of an investment. Then let me pick back through the representations that people have made to you, check the facts that they've utilized, check the numbers that they've projected, check the reality of the tax law that they think that they're going to protect you from. And I can just tell you this, in almost every single case, there are ways to show you that that might not be in your best interest. I added one more thing onto this, and that is there's a lot of groups out there today that say, are you in debt to the IRS? And we can get you out of all that debt, and we can take care of it all for just, wow. And they ask you for upfront money. They say something like, boy, if you'll come in and pay us $5,000, we'll get you out of that $40,000 in debt that you owe to the IRS. I'll just tell you this, the IRS commissioners throughout time have been very adamant about this. There's just not that many ways ultimately of getting people out of paying that money unless you're absolute destitute. You're destitute. And for those who have actually audited the representations that people make on those commercials on TV or on the radio that promise that they're going to get you out of debt to the IRS, it's very rarely ever something that ultimately ends up happening in a positive way for you. And we're going to talk about Roth IRA investing. In fact, we'll get into something that, that's been one of the ones that people have become most excited about. So let me make sure you understand this concept of a Roth IRA. So what's a traditional IRA versus a Roth IRA? You have each year the opportunity to make an investment in what works like, it's not technically a qualified retirement account, but it works like a qualified retirement account. They work a lot like a 401k that we've already talked about. You can put your money into the investment, and at least in the past, you put your money into the investment. You don't have to pay taxes on the money as you put it in, and you don't pay taxes on the growth of the income as it's growing, but then when you're pulling it out, you have to pay taxes on it. Well, along came an investment called a Roth IRA. And in this case, they said, you do pay the tax going into the investment. So let's put your $5,000 or whatever it is into the investment, but pay the tax right now on that money. Then all the growth of the investment and when you're pulling it out, you never have to pay tax again. It swept the country. I mean, financial advisors loved it. I want you to know, I've actually spoken before large groups. I once had a group of 650 life insurance agents, stockbrokers, CPAs, registered investment advisors, and others that were there engaged in a continuing education course that I was teaching. When they asked me what I thought about Roth IRAs, and I said, I don't support them. I don't agree with what people say about them. Their jaws hit the floor. Let me just show you ultimately how it would work and what my concern was about those investments. I'm going to just kind of give you some hypotheticals. We're going to assume that you put $500 a month into one of these investments, into a Roth or a traditional IRA. We're going to take an investment annual growth rate of 10%, and we're going to assume that your employer will match 100% of your contributions. Let me just show you what would happen in this circumstance. Let me just assume that you're in the federal tax bracket of 0. So you just don't make enough money, so you're not paying taxes right now. If you're not paying any taxes right now, then what you put into the Roth or into the traditional will be the exact same amount of money. So put $5,000 into the Roth and pay no tax. Put $5,000 into the traditional and pay no tax. In that circumstance, it would obviously be best to do the Roth just because you're absolutely in no federal tax bracket at all. But what would happen if your tax bracket was a little higher, which 85% of all of Americans do have some tax that they pay? So in that case, let's assume that you're in the 15% federal bracket and 7% state. That's a total of 22% in tax. If you put your money into the Roth, guess what? You pay your money away, all the tax on that you pay away to the IRS or to the state where you live. So what I've done is said this. Now watch, this was the key ingredient that changed the minds of all the people that were in class that day. I said, what would happen if the person, instead of paying that money away to the federal government or the state, they actually invested what they saved? Now remember what our $1 million choices were? Our $1 million choices is finding some way that you can save an expense that you're going to incur, but instead of just saving it, you're going to invest it. So in this case, instead of sending the money away to the IRS or to the state government where you live, let's take that money and just put that into my IRA account. What would happen? Instead of this amount that you'd have, let me give you one more number too, and that's just what would happen if you're in the federal tax bracket of 25% or 7%. So now, can you see why it's all the same number if you're paying your money away to the federal government? So if you do a Roth, you're going to still have the exact same amount of money over the 45 years between now and the time you retire. you'll have accumulated $5,250,000. That's the Roth, or it's even the traditional IRA if you're in the 0% tax bracket. But what would happen if, in this case, where you're in the 15% federal bracket and 7% state, what if you chose to invest the money that you saved in taxes? You just put that right into your IRA or into your traditional IRA account. In that case, by the time you retire, you'd have $6,720,000 or 22% more. That's quite a bit of money. 22% more you'd have in that account. That's that's a lot of money sitting there at the time that you would not have if you did it the other way. What if you were in the 25% tax bracket and 7% state, so 32% bracket by the time, and you remember you're going to invest all the taxes that you save, you'd have $7,710,000, 32% more. You'd have 32% more money in your IRA account if you did it in the traditional account. Then I wanted to do one more thing. Remember this: if you save that money inside of an IRA and your employer is matching 100%, look how much more you'd have in that. Actually, you'd have $10,170,000. Now look, can you see what just happened? If you're in this tax bracket and you had that employer match, you literally have twice as much. You'd have twice as much in your investment as you. Now, if you had twice as much, what if you are in the 30% tax bracket when it comes time to retiring? Could you afford to pay 30? So 30% of $10 million is $3 million. So your net amount from your IRA is $7 million. So the net amount from the IRA is $7 million. The net amount from this, if you just put it into the Roth during that exact same period of time, is $5,250,000. I have a list that we're going to publish of 19 other reasons why I don't believe in Roth. So just know that, and there's others. I'd love to tell you all the others who have said the exact same thing. I think my list is probably longer than anyone else's because I've worked on it so much on behalf of my students. Can I just make sure you understand? Make sure before you make the Roth decision. We also have in 401ks, you have the Roth equivalent, so where you can put your money in and pay your taxes. I just want you to get this vision. I want to make sure you understand this very clearly. If you elect that Roth, that means every single year, let's just say you're going to put $10,000 into your employer account. That means that every single year you're going to send away $3,000 to the IRS or to your state, $3,000 to $4,000 that you can never get back if you make the wrong bet. I would just highly recommend you have somebody that knows what they're talking about, that tells you the differences between Roths and traditionals before you make the decision to put your money into a traditional IRA. It might be a very healthy thing for you long term. Something else when it comes to investing that we've always talked about is this. There's a lot of people, and I can use the name because it's such a public thing right now. There's a guy named Bernie Madoff, and Bernie Madoff made a bunch of investments for people, and he kept sending in these statements that showed that their investments were worth X amount of money. What they came to find out were all those statements were printed in the basement of the office building where they had their company. And what they found out was all the numbers that they were reporting on those investment statements were inaccurate. They were falsely stated. But they came from that investment company. Whew. Can you understand why there's a problem there? I can print any number on any page that I want to if I'm not as legitimate or as honest as I should be. And you, as the investor, get this statement in the mail that says that my investment's worth a ton of money when indeed your investment might not be worth a lot of money like that. In order to avoid that kind of situation, can I just recommend that something that you always do? Now remember, we have already recommended that you have your statements audited. You have the investment audited. The second thing I'd like to recommend to you is that you receive a third-party statement from somebody other than the person that's actually investing your money for you. So let's say, for instance, you have an investment advisor that's investing your money at Charles Schwab or at Fidelity or at Vanguard or there's just hundreds of different groups that can invest your money. So I don't want this to be seen as some kind of an advertisement. I just knew that you'd recognize the name Charles Schwab. Make sure that you get on a regular basis a statement that was actually sent out by a third party, someone other than the individual that's making those representations to you. That would, in that case, where Bernie Madoff was sending out those statements to people, that would have solved the problem right now. If I could literally make sure everyone has an audited financial statement of the representations that are being given, and they have a third-party statement being sent out to them, that would probably avoid 80 to 90% of all fraud out there today if people would just follow that kind of a benchmark. Something else when you're dealing with a broker-dealer or an investment advisor, something else. I want to see if you can understand this. It's very easy to look back. So let's just say I'm an advisor. And I come to you and I say, man, I'm just going to tell you this. Last year, gold went up by 500%. Of course, I don't know that there's ever been a year when it went up by 500%, but we're just throwing out a number. Or any investment. And I can say, wow, this investment went up by 500%. And I'm actually now recommending that investment for my clients. Do you see how easy it is to go back and look in the past, pick out an investment that's done very well, and say, hey, I'm recommending that for my clients now? One of the ways you'd have of avoiding that is just ask the advisor to show you someone a string of people, maybe 5 or 10 people, that could tell you that this advisor had his people in that investment during that period of time. It's very common in the industry. There's lots of regulations designed to overcome it, but few of them are really as efficient as they should be. Can you see how? Make sure when someone says, hey, there's this investment and it can make a lot of money, you very carefully assure yourself that the advisor that's making that investment recommendation for you actually had his people in those accounts during that period of time. I've kind of kept real estate until one of the last things we talk about, just because real estate is something that people always have a lot of questions about when it comes to, is that a good investment for me? I will tell you from the very get-go, real estate can be a tough investment. I'm going to show you some pros and cons of investing in real estate. I'm going to try to explain it in a way to make sure that I've given you sufficient information that you can make some very solid choices about whether it's a good idea for you or not. Sadly, there are a lot of things that I can tell you in a very adamant way that you avoid whenever possible. There's a lot of people that will go around. There was once a book called Nothing Down Real Estate. Of course, there are lots of books that say something like that. You don't pay anything down for the investment you're making, and you make yourself fabulously wealthy by acquiring a lot of property. If someone says you put nothing down, so let's say, for instance, it's a duplex that the value is $400,000, and you don't put anything down. How much leverage, how much debt do you then take out to fund your investment, to purchase the real estate? That means you got to take out a $400,000 loan. Debt against the property is also what those that teach these workshops love to call leverage. You're going to leverage this wonderful investment, because if you put nothing down and that real estate goes up by 10% in value this next year, think of all the money that you've made. That's an unlimited amount of return, because you put in zero of your own money into it, and it went up by 10%. Crud, that's a wonderful kind of an investment. The sad thing is that most everyone who's ever engaged in nothing down. Now, there's some people that have made money. There have been some people that have done okay. It's very rare. So in this case, I'd like to just say that, I like to, in my workshops, I'll always ask people, have you ever invested in commercial real estate? Have you ever owned a piece of property like that? And probably half the audience will raise their hands. I'll then say, okay, leave your hand in the air if you liked the investment returns and you actually enjoyed owning that real estate. And of the 50% whose hands were up when I asked them if they have invested in real estate, probably 90% of those hands go down. They had a bad experience. Can I tell you that probably 90% of all people that have ever invested in real estate on a commercial basis had that same bad experience? It's very risky. And the risk is only greatly compounded when you do this thing called nothing down investing. I would highly recommend that you avoid that at whatever cost. Because investing in real estate can be so tricky, you have a lot of people who will say, hey, don't worry. You pay us $5,000 or $10,000 or something like that, and we're going to provide you a professional that can work with you on an ongoing basis and make it so that that your decisions will be made wisely. So they set up these professional consulting services. I just have to tell you, I don't know that I can explain it in a short enough time to justify the kind of time we're talking about here, but or the time we're taking. Can I just tell you this? I've seen personally a lot of these individuals that they're saying, these are the professionals that are going to help you, and the guy that's helping you went through a two-week workshop on how to do real estate investing, and he's the guy that you're paying $40,000 a year to sit on the phone and tell you what's going to be good and what's going to be bad about investing and direct your path. There are those. In fact, there's kind of one right now that's become very popular. The guy set up a big university. The big university was going to teach people and charged fabulous amounts of money to people to come to the university to teach them about how to make tons and tons of money doing real estate and other kind of business investing things. And I can't remember the exact number, but it was some 5,000 or 6,000 of the people that attended that university ended up suing the individual that started it for fraud, and they hope to get back some of their money. There has been actually a settlement paid in that case so that they get back some of their money. Do you see what I mean? It's just so easy to think that somehow somebody's going to have the information that's necessary to give you that's going to make you so successful at something that in the past for so many people has become so tricky and such a difficult kind of an investing. I've always just recommended to people in that case that they find, if they possibly can, some kind of a CPA or somebody that on an ongoing basis can provide you some kind of advice, but they do it at a fee that's very nominal or reasonable compared to these people that are going to charge you this tons of money. There's also something called real estate flipping. Flipping only really works well when the market for real estate's going up. And flipping fundamentally says this, in its purest form, it means this: I buy a piece of real estate and sell that piece of real estate just in either the same day or real soon thereafter and make a bunch of money. So I might buy it for $300,000, and because the market's going up, I find somebody else right now that I could sell that same piece of property to for $360,000. I buy it for $300,000, I sell it for $360,000. I take no risk. Now, there's a lot of variations on that same theme where people make a lot of money by, quote, flipping real estate, by just buying it and owning it for a very short-term period of time and selling it. Boy, it sounds good, doesn't it? It sounds really exciting. The problem is whenever you buy that real estate, what do? You incur a debt. You actually sign on a dotted line that says you'll pay a debt. That means that if indeed the real estate goes south or the market suddenly turns and doesn't do as well as you thought that it would, you ultimately lose a lot of money. Just talked to an individual just yesterday came to my office. He went down, he had a property down in California that he was so confident that he could just flip. He bought it, put some real quick kind of fix up into the property, something like that, and couldn't sell it. And literally ended up losing over $500,000 on a single transaction. And it's caused some real financial chaos in their family and destroyed what had become what was projected to be a very comfortable and wonderful retirement. You be very careful with real estate flipping, and especially careful with those individuals who say, don't worry, but for a nominal fee, I can teach you how to do that real estate flipping and make a ton of money. It can be very, very, very challenging. We've already talked about unaudited claims. I'll tell you this, those that are selling these real estate strategies, that I've never seen one of them that have some kind of an audited statement. And when we go back and try to do some kind of an audited or investigative attempt to see if somehow the representations they're made, I'll tell you this, you go back and look right now, some of the people that are out there that are making the biggest amounts of money selling books on finance, and I'll just show you how many of those people make statements that when somebody goes back and audits those statements, they don't turn out to be as correct as we hope that they would be. The leverage that we just talked about can obviously be a very difficult thing. Let's talk about real estate. I'll give you a couple of more things that could make it so that if you decide you're going to become a real estate tycoon, you're going to buy lots of real estate, what is it that you're ultimately doing? Let me see if I can give you some benchmarks real quickly that I think should be helpful to you. Let me tell you some of the positive things about owning real estate like that. Number one, the leverage. If indeed you can make money, and I'm going to give you a little quick example of what that means to use leverage to make money. Let's just assume that I buy a $400,000 duplex, and of that duplex, I take out, I put $40,000 down, so that's about 10% down. That means that I've got to take out a loan of $360,000. With that 40% down, let's just assume this. What would happen if in the next year that real estate actually goes up in value by 10%? So if the real estate goes up in value by 10%, what's happened? I actually made 40%, so $40,000, not 40%, but $40,000. I made $40,000 on an investment. I pulled $40,000 out of my pocket. What does that suggest? That means that if I had a $40,000 gain, if I put $40,000 down of my own money and I get a $40,000 gain, what does that mean? It means I got a 100% gain on my money. That's a lot better than investing it in a money market account and receiving a 1%, isn't it? And you say, well, why would I do a money market when I can expose myself to that wonderful? So do you see what leverage does? So this is what they love to in these workshops call other people's money. You borrowed that money from somebody else, put down $40,000 of your own money, and made $40,000. That's 100% gain. That's exciting. Now, as exciting as leverage can be, let's just flip that though. What if the real estate went down by 10% in a year? If it went down by 10% instead of going up by 10%, how much did you lose? That is literally 100% loss of your money. Ooh, now you're kind of seeing where leverage can be really, really good when the market's going up, but leverage can be devastating. It can literally take away a person's entire fortune if it's used or if the real estate goes in a different direction. I just have to tell you, like back in 2008, when the real estate market dropped by as much as 40% in some areas, there were as many as 50% of all people that owned a piece of real estate that had any kind of debt against it, literally had a debt that was worth more than the real estate was worth that they owned. They were the ones caught in this trap right here. I'll tell you, I wish I could tell you how many people come to my office that we go through that with, and I'll show you how devastating it can be and make sure that you understand why. Just don't let that fancy marketer that's going to charge you $40,000, $50,000 to get a consultant or to have some kind of a special strategy get you hooked on something where you don't clearly understand the obvious risks associated with making the exact same kind of an investment. So that's the first thing, is leverage can be a wonderful positive thing. It can be wonderful when somebody else is buying your investment. I remember one time we were standing out in front of an investment one of my clients owned, and it was a little duplex. And I remember him looking at me and said, I want you to know something. I want you to know something. The two families that live in that duplex go out every single day, and they work their knuckles to the bone so they can come up with the money to buy my investment for me. So in other words, they're paying, as long as it's a positive cash flow, so you're getting good income from your real estate, then that means that they're the ones that are actually paying the debt. They're the ones that are actually paying for the expenses on your investment. That sounds like a very cool thing. And indeed, when it's working correctly, it can be a cool thing. So we're just going to say, as we talk about these very lofty, wonderful values that you can get from doing investing like this, we're going to suggest that you can actually have somebody take care of all the rent for you, or take care of purchasing the investment for you. There's something else, a value that comes from it for tax purposes. Now, see if you can catch this. If I own a piece of real estate, guess what? The IRS will allow me to treat that real estate as going down in value. So actually the building itself, not the land that it sits on, but the building itself decreases in value because it's getting older. They, on your tax return, allow you to take a depreciation expense on what they refer to on your Schedule E, the supplemental. So they take the depreciation statement is the 4562 statement. You calculate the depreciation on the real estate, and you can take that as an expense against your income. Well, now think about it. That means that, did I actually have to take money out of my pocket to pay that expense? No. It's a non-cash expense, that depreciation you can take on your tax return against other income. That's obviously a very positive reason for investing in real estate. You get that non-cash expense. Something else, when I get these very successful strategies to become a tycoon and want to own a lot of this, is that when we talked about this in our as it related to owning your home, we told you that for whatever reason, it's behaviorally sound. We just make the payments in a way that sometimes is remarkably disconnected with everything else that we do so irrationally with our money. Imagine this. In this case, we're just going to, we're going to own all these buildings, and we make our payments on a regular basis. So it is what I would refer to as behaviorally sound to make those kind of investments. Unfortunately, there are some negatives. What are the negatives? Some are very obvious. The leverage, when it's high, we just talked about that, how you can lose a lot of money on those investments if you don't take care of them, and they actually go down in value while you're owning them. How many of you, I've always just asked this question, I love to ask my students, raise your hand if you'd love to be a landlord. Well, a lot of them will raise their hand. I'll say, how many of you have been landlords? They'll raise their hand. I'll say, how many of you enjoyed it? and the hands go down real quickly. It's hard being a landlord. Listen, we could take a whole hour talking about this, but I'll just say, what's going to happen the day that you put a little family in your rental unit, and let's say there's a divorce, and let's say the one or two of the parents go away and they're not making their child support payments, and the payment, the spouse that's left sitting there in the house that's got 3 little kids comes to you and says, I can't make my payment this month. Can you just kind of forgive it, or can you just give me a cut or a break or something like that? It is hard. It is hard, especially when there's been some kind of a catastrophe, there's been some kind of a disaster, some kind of a medical problem, something like that. It is really hard to be a landlord. It's really hard sometimes when you get a call at 3 o'clock in the morning and their toilet has broken and there's water gushing out on the floor and it's leaking onto the tenants underneath in the lower level. And you have to rush over at 3 o'clock in the morning to stop that toilet from overflowing and make sure everything is okay. Before you decide to do real estate, you talk to somebody that's owned a lot of pieces of property and just ask them about the problems that are associated with being a landlord. And I think most people, I think if they really made a serious attempt to understand what the problems or frustrations are, would elect to say that it's not probably something that would be long-term something that they'd like to do. Just make sure you know this. I've always told people this. If you're going to go into the business of owning real estate, just make sure you treat it as a business and not just a passing kind of a hobby activity. A lot of people like to think, boy, you just buy it, you put some people in it renting it, and they just make their rent payments and everything is good. It obviously can take a lot more time and create a lot more frustrations than you might have ever previously imagined. You know, when we invest in the stock market, I like to tell people this. There's a lot of people that come to me and say, you know, Scott, you've suggested that we invest in the stock market. Boy, do you know how frustrating that is? Do you know how nerve-wracking that is? I like to invest my money in real estate where I don't have that same problem with the values going up and down. Do real estate values go up and down? They absolutely do. Why is it that you're not as immediately aware of your real estate going up and down in value as you are of stock going up and down in value? Well, stock, you can open the newspaper every single morning and find out exactly what that stock has done on the previous day. You don't have to wait for the next day for the newspaper. You can get on the internet and sit there and look at the screen every single day and look at it for hours and hours and hours and watch MSNBC or some kind of another business program that gives you on a minute-to-minute basis what's going on in the market, and you can know exactly what's taking place with your investments. Subjecting yourself, obviously, to the fluctuations in emotions that come with those same fluctuations in the market. Can you do that same thing with real estate? No. You obviously have in real estate something I'll refer to as evaluation or tracking uncertainty. You don't know how much it's gone up or down in value in a single day. If people did, their enthusiasm for thinking that real estate is just this solid investment that does nothing but go up, obviously that would be tempered a great deal. My last one is just illiquidity. Illiquidity just means, liquid just means that it's an investment that it's either cash or I could turn it into cash within 1 year. If I own a stock or a bond or some of the other investments that we're talking about, I can readily turn that into cash within a day. I just get on the internet and punch in what I want to sell or what I want to buy or whatever else, and the cash will be available to me either by the end of the day or by the very next day. With real estate, it can be very tough. What if you owned real estate back in 2008 when the market started to drop so much and you wanted to get out? You wanted to, and let's say it's not just a real estate, some kind of a fluctuation in the market. Maybe you really did have some other financial obligations that you had that you wanted to have some cash for. How hard is it to sell your real estate? I've stood a number of times before, but the one that was most poignant to me was a guy that I knew very well that had come to me for some advice. Of course, unfortunately, he came to me after the problems had happened. He owned about $30 million in real estate. Now get this, $30 million in real estate, that he only owed about $10 million against that real estate. So he owed about $10 million. So he really had what he referred to as a $20 million in net worth. I don't know if we've talked enough about net worth. Net worth just says this: if you took the value of all your assets and subtracted the liabilities, what you owe against those assets, that's your net worth. That's your net worth. He had a $20 million net worth. We'd call him a multi-millionaire, and we were sitting in bankruptcy court, and he lost all of it because he couldn't make the payments on that $10 million that he owed, on the debt that he owed, and he couldn't sell the real estate fast enough to satisfy the creditors who wanted their money on those $10 million in loans. Imagine that, a $20 million net worth bankrupt, and he lost every single piece of that real estate because he could not make the payments, and he could not sell the real estate fast enough to satisfy all those that wanted their money. Can you see how liquidity can obviously be a very difficult thing? Let me give you real quickly some principles of owning real estate that I hope will make it a little more valuable to you. Number one, avoid nothing done workshops. We've already talked about that. Number two, avoid those real estate counselors. Avoid real estate universities or something like that that tell you that they're going to make you fabulously wealthy because you've got all. Avoid timeshare investments. Take a little bit of time to describe this. We've talked about them a little bit in the past, but what's a timeshare investment? Along comes, you go to some fancy resort community and they've got a beautiful, beautiful hotel sitting there, and they say you have the opportunity to buy a piece of ownership in that hotel. So it's a timeshare. You actually buy an ownership right to it, and you can come to it any time that you'd like to. Well, not any time. They have certain weeks of the year that you can come and you can be there with your family and enjoying this real estate. It's pretty captivating. Probably most everyone watching this has actually seen a timeshare sales presentation. It's a real hard pitch. Boy, it's very tough sell, hard sell kind of approach. So you get excited about it and you say, okay, so it's going to cost you, let's say $20,000. They say $20,000 you buy this share in the real estate, and then you pay about $800 or $900 a year for maintenance of the property. And you think you've bought yourself some kind of a really sweet deal. I'd love you to go out. There's some websites where you can, and boy, when you get there, they'll say all sorts of things about, boy, when you buy this thing just does nothing but goes up in value. We sold some units in this exact same facility a year ago. Now we're selling phase 2 of this same project, and phase 2 selling for more than phase 1 means that the phase 1 people could sell their real estate, sell their units for this extra price, and so it's a really, really wise investment. I will tell you this, that the average real estate timeshare that you purchase, investment timeshare, will depreciate by nearly 60% in value as soon as you've purchased it. 60%. If you bought that thing for $20,000, then you wanted to go out and sell it to somebody else, under that scenario, you'd have lost about 60% or $12,000 in value of the money that you put into it. Instead of the $20,000 you put into it, you might only be able to sell it for $8,000. And that's real good. I will direct you to some real estate timeshare websites where people have gone out and put their money into those kinds of projects before. Well, they will, in that what we call the secondary market. So the primary market is when you bought that timeshare. Now you want to sell that timeshare unit to somebody else because you don't want to hold on to it anymore. And so we call that the secondary. Primary is when you bought it, when the original owners bought it. Secondary, now you want to sell it to somebody else. You can go out right now today and you can purchase timeshares that somebody else has purchased. And I'll show you websites where they will actually give the timeshare away if you'll just make those annual payments for the maintenance of the real estate. We find that once we've bought it, it's not quite as exciting, and it's real frustrating to have to make those annual payments. Not only are there websites where you can purchase, where they'll just turn it over to you if you'll make those annual payments, there are literally websites I could show you where companies have set up and said, we'll take over the timeshare for you. We'll actually take over the payment of that if you'll pay us $3,000 or $5,000. How's that for an investment? I bought it for $20,000, and I've got to pay somebody $5,000 just to take it off my hands. Can I just say, if you want to buy timeshare, go buy it in the secondary market. Go look at those websites. You can go buy those exact same units that somebody else has purchased, and you can purchase them for a fraction of the cost. Almost every single one of them will sell for 10, 20% of what those people paid for them when they first purchased it. Is it surprising to you that I say avoid timeshare investments? I'll tell you this, with what we've got now with Airbnb and some other opportunities for people to actually enjoy, purchase it, enjoy the benefits of living in a piece of property like that for a period of time, I see almost no reason whatsoever to actually purchase a timeshare unit unless you know for an absolute fact that you're going to be using it on an ongoing basis and it's worth the money that you're suggesting or talking about. I will just suggest that you be very careful and make certain that somehow that fits a profile where you understand what could happen on a long-term basis. Timeshare is just not. We've actually taken to saying this. We like to suggest to people that instead of owning something like that, we have something that we call smart usership. So instead of ownership, smart usership is finding somebody else who actually owns the property, has to go through all the hassles that you're talking about, and just pay them rent on it for the period of time that you're going to be using the property. Employ excellent CPA advisors. We already talked about that. Whenever possible, have somebody that on a very nominal, for a very obvious fee will provide you recommendations or suggestions. We think that's a good idea. If you're going to purchase pieces of real estate like this, I think it's well for you to know that those who have done a good job at this in the past have established a great relationship with a bank appraiser, somebody that appraises these properties for a bank. So when a bank takes back property that they have to then sell again, they're going to have appraisers come and look at it. Those appraisers can provide you a lot of really good, excellent kind of ideas about where you might be able to purchase that real estate at a fraction of the cost. Let me just give you some quick guidelines. It's the last thing I'm going to tell you. I'll give you quick guidelines for owning real estate. Make sure that whenever you buy a piece of real estate that you could have 50% vacancy for 6 months or longer. That means if 50% of the people that are renting the property from you moved out, you have sufficient cash flow. You have enough money that you can pull out of your own pocket to pay those payments for at least 6 months before you'd ever consider that. That would eliminate almost all nothing down real estate, because most people don't have the money or that they could make those payments and not go broke because they couldn't make the payments. Do not own long distance. I have a lot of people say, I got a property in Tuscaloosa I'd like to buy, and I say, don't own long distance. I always give them this advice. Make sure that you could drive by the property every single night that you buy. Make sure that you can take a look at it, because we know by sad experience that people can move out. They can kick the living daylights out of a piece of property and cause a lot of damage, and you won't even know about it if you're a long ways away from it. Do everything you can to not own property long distance. If you're going to own real estate that you could actually drive by, check every night to make sure that indeed it's in good shape. Make sure that before you buy a piece of property that you'll live there for at least in that area for at least a 5-year period of time. So don't buy something that you won't live there for at least 5 years. I've always suggested this to my students. If you'd like to get into this, you'd like to make a good first step to see how it would work for you. There's a very simple thing that I've suggested for them as a possibility. Your first home might want to be a duplex. I like that. I think that's a kind of a good way to kind of slip into it, see what you think about it. Then the amount of money that you pay, then you're paying for one side of it to live in it, and you have somebody else working the other side. Then you can keep track of your property on a much easier basis. I'd like to recommend or suggest that as we do this. Now remember, we talked in the first part of our lecture, we talked about investments and making wise investments and doing it in a way that the professionals, the Nobel Prize winning professionals would suggest that you make investments. In the second part, we just took those kinds of things. I think if we could literally, because imagine for yourself, after taking a workshop like this, you could write down those things that we'd like you to avoid or like you to consider very carefully because there's a great deal of risk or even fraud associated with it. Wouldn't it be cool if you could actually avoid what has become to so many other people such a devastating part of the experience that they have in investments? I think that there's a possibility that this investing process can become something that's very wise. It can become something that's very satisfying. It can become something that's a very integral part of becoming what I would like to always suggest is something that's called a perpetual multiplier. You have the ability to always get, manage your time and and discipline your attitudes and the ideas or concepts of value in such a way you can make systematic investments that make it so that you're constantly multiplying resources and obviously being blessed through the value that those resources can provide to you on an ongoing basis. I believe it can be a very satisfying, a very gratifying, and even an eternally fulfilling process of making wise investments and avoiding some of those problems or frustrations that are part of a very normal emotional approach to taking or investing your money. I'm confident that it can become something that will provide you the rewards and the benefits that you seek without taking too much risk. Thank you.